A very good afternoon, friends. I, Vishal Doshi, Chairman of the Financial Report Review Board, welcome you this afternoon to the webinar on common non-compliances observed in financial statements and auditors report. We are privileged to have with us our Honorable President of ICI, CA Charanjot Singh Nandaji. I'm also joined by the Vice Chairman of the Financial Report Review Board, CA Hansraj Chugji, the Secretary of the Financial Report Review Board, CA Ankita Manglaji. We are also having the expert panelists with us who have joined virtually, CA Alok Gargji, CA Chinnaswamy Ganeshanji, and CA Vivek Agarwalji. So once again, I welcome you to this webinar. As you are all aware, the Financial Review Reporting Board is a regulatory board of the Institute of Chartered Accountants of India, where we do the function of review of the financial statements on a regular basis. But we are privileged to have with us our Honorable President here. So not taking much time, I would request President Sir to please address the participants.
A very good afternoon, ladies and gentlemen. CA Vishal Doshi, the Chairman of Financial Reporting Review Board. CA Hansraj Chugji, the Vice Chairman, Office. Very esteemed colleagues, dignitaries, ladies and gentlemen. I am truly honored to be amongst you this afternoon. The onerous responsibility as shared by the board and taking it to newer heights by conducting webinars on common non-compliance observed in financial statements and auditor's report would go a great way in enhancing the credibility of our profession. This will result in strengthening the accounting policies, auditing practices amongst our members and other stakeholders. Ladies and gentlemen, you are aware that this board, the Financial Reporting and Review Board, emerged as a beacon of excellence and trusted with the responsibility of conducting reviews of general purpose financial statements and auditor reports of various enterprises with a view to determine the compliance with the generally accepted accounting principles and the disclosure requirements applicable to them. Let me also put across to you that based on the review, if FRB finds any material or something which is serious non-compliance affecting true and fair view of the financial statements, it refers the case to Director Discipline of the Institute for further investigation, as well as to the regulatory body relevant to the enterprise like MCA, SEBI, RBI, IRDA, etc. I would also like to tell you that the board has undertaken a review of companies representing 70% of market capitalization in 3 years. Till date, the board has reviewed and concluded 1269 cases. Out of these, 201 cases have been referred to the Director Discipline for further action. 179 cases have been referred to various regulators, including MCS, SEBI, IRDA, and RBI concerning the respective enterprises. A total of 35 reports have been submitted to the Election Commission of India regarding the financial statements of political parties. The board has issued advisories to auditors in 788 cases, which motivates auditors to follow quality practices and high sense of professionalism in carrying out their professional duties. It showcases the dedication and diligence of the board in encouraging exemplary financial reporting practices. Ladies and gentlemen, you are aware that this webinar serves as a platform for sharing, for knowledge exchange, and more importantly, having the indulgence of industry experts and practitioners. By sharing experiences, challenges, and solutions, we can collectively work towards raising the bar for financial reporting standards in India. Also, it will ensure better regulatory compliance, improve audit efficiency, supporting the professional development. Ladies and gentlemen, we all have to remember that when you go towards excellence, you have to prosperly go on. You can't look back. It's a constant, perpetual journey where you learn so many things. You make your constituent learn so many things, but the ultimate purpose is enhancing the audit quality, ensuring that financial statements all across the globe give the same inference for what it was created. Any investment decision, whether it is taken in Frankfurt, New Jersey, or in Kathmandu, all of them should have the equal relevance. The data should direct them to the right place. I will end by a small couplet. The couplet says, अपने हौसलों को खबर करते रहो, अपने हौसलों को खबर करते रहो, जिंदगी मंजिल नहीं सफर है, चलते रहो. You all have to traverse the path of progress. I sincerely hope that members will find the webinar highly useful for their professional development. I thank the chairman, Shri Vishal Doshi, and Shri Hansraj Chugh, vice chairman, for taking such initiatives. Their initiatives will go a long way in paving a great compliance environment and, more importantly, an enhanced reporting mechanism for all of us. Thank you. Thank you so much.
Thank you, President, sir. And I would just like to inform the Honorable President and all our panelists also that we have been joined as participants by a lot of preparers, members in industry also.
Very good.
Because that is also at the first point. Where
I know Alok ji is there, Vivek ji, Chairman Ganeshan.
And sir, recently in February, we came out with our third publication on the IND-AS, the commonly found errors, which is the largest volume of the publication so far released by the FRRB, which has 200 plus observations covering 88 financial statements for the benefit of all the members. So once again, I thank our President, sir, and I would request our Vice Chairman, sir, to share his views and also propose a vote of thanks for the Honorable President.
Before I withdraw, I would acknowledge the presence of Shri G. Ramaswamy, our Honorable Past President from Coimbatore. Welcome, Mr. Ramaswamy. Your presence here gives confidence and inspires all the participants as well as organizers to perform in a better way. Thank you. Thank you so much.
Thank you very much.
Yeah, thank you. Really being our President, sir, is really been so kind. He has always been look forward and always think about the future. Rightly said so many words for the FRRB, always been inspiring and very close to the FRRB. And the way he really brought many new things to guide to this board, as well as the objective of today's program also. चलते रहो चलने का नाम जो है वही जिंदगी है. The way really he has always been saying progressively, whatsoever we are now, a moment thereafter, once this webinar will be over, will be more strengthened with the knowledge from our different speakers and the panelists. I'm really grateful and thankful to the Honorable President C.A. Charanjot Singh Nanda ji, who has taken time out of his busy schedule. Our past President also available with us virtually, G. Ramaswamy ji, with whom I have memories since my regional council, and he has always been a guide to me. And our chairman, C.A. Vishal Doshi ji, who has always really been bringing out so many good things to this board, always been look beyond or it is out of the box thought process, whether in the challenging times or otherwise, wherever we look forward, how the knowledge to be brought into the last person sitting at a different location, whether it is the preparer of the financial statement or the auditors, those who really attest it out. So for the taking out whole ecosystem together. And thanks to the our speakers and the panelists around us and many other friends across, those who are available as a participants will be starting technical session thereafter. I'm really been so kind to Thank you very much.
Documents
Please carry on. Thank you so much.
Thank you, sir.
Okay.
For your
Yes.
participate. Moving on to the session. Before I hand over the proceeding to our panelists, I would like to introduce our panelists to the participants. Alok Garg ji, All India top 3 scorer in accountancy, is a distinguished professional with over 17 years experience in the field of finance and accounts. He is CACS with additional credentials such as diploma in IFRS from ACCA and certification in Ind AS and BRSR. He holds an honorary doctorate in financial reporting and accounting from American East Coast University, New York. He has been awarded with National Education Leadership Award from Ramanujan College, Delhi University. He is renowned author of 4 comprehensive books on India and Schedule 3. He has delivered over 850 lectures at national and international platforms. So we are really honored to have you with us, Alok sir. Chinnasamy Ganesan ji is a veteran in the field of auditing, bringing over 36 years of rich and diverse experience across Indian and multinational clients. He has delivered more than 1,500 lectures globally on auditing and Indians. He has authored several books and has been instrumental in guiding over 80 companies in their India's transition. His accolades include an honorary doctorate in IFRS, the Lifetime Achievement Award in Finance from Rotary International, and the prestigious Jewel of India Award for his contribution to the financial services. He is faculty at prestigious institutions such as IIMs, Reserve Bank of India, C&AG, CII, FICCI, and other leading universities across world. CA Vivek Agarwal ji is a distinguished fellow chartered accountant and fellow company secretary with expertise in India's forensic audits and assurance services. He holds a diploma in IFRS from ACCA UK, DISA from ICI, and certification in forensic audit and India's. Additionally, he has pursued an executive course in business analytics from IIM Calcutta. He is a seasoned speaker, having addressed over 1,000 national seminars and workshops on India's IFAC auditing standards, and has also served as a trainer for government bodies, including the Ministry of Finance and C&AG. We welcome you all, and we are really honored to welcome multifaceted and accomplished professionals to our program today. Vishal sir, I request you to please proceed.
Thank you, Ankita, for those introductions, and thanks to all the panelists we have today. So we'll start our I would say the first call to Alok Garg ji. Alok ji, the facts are something like this. So before that also, I would like to share with our participants that in case you have any questions in furtherance of the responses given by the participants, or any other clarifications that you seek, you can kindly put it in the text box, the chat box that is there. So our team would compile, and time permitting, we would definitely ask our esteemed speakers your questions also. So Alok ji, the facts are as such that a fire has occurred at one of the company's manufacturing facilities, resulting in damage to the property, plant and equipment, as well as the inventories. The company has lodged a claim with the insurance provider, for which the losses are currently under assessment. Additionally, the company has recognized some losses of a few million rupees, along with the minimum insurance claim receivable in its financial statements. And these losses and the corresponding insurance claim receivable have been presented on a net basis under exceptional items in the statement of profit and loss. So these are the facts, the background. Now the questions, Alok ji. How should the company account for the fire-related losses and the insurance claim receivable in its financial statements, particularly with respect to the presentation under exceptional items in the statement of profit and loss? The second part of the question, is there any difference in accounting for compensation from third parties like insurance companies between loss of property, plant, equipment and inventories in the statement of profit and loss when it becomes receivable? And the last part, how to account for such losses where at the year end, in case no claim has yet been filed with the insurance companies? So over to you, sir.
First of all, thank you, Vishal sir and Hansraj sir and the entire committee for this opportunity. And good afternoon, everyone, and to my fellow speaker, Ganeshan sir and Vivek ji. So I'll split this question into 3 parts. Number one, whenever we talk about, recognition of expense, we look at the conservatism principle, right? So you have to make a provision for all the losses and expenses. If we look at the income, So the principle is certainty, right? So when you will recognize an income, you have to recognize an income when you are certain that yes, the money will be received and the company will have this income, right? Talking about this scenario, in this scenario, three standards will be applicable. Ind AS 2 when I touch upon inventory, Ind AS 16 when I talk about property, plant and equipment, and Ind AS 37 when I talk about insurance claim receivable, right? As far as the first question is concerned, so the company has a fire and they have some losses with respect to PP and inventory, and they have some insurance claim receivable also. So what should be the right presentation in the statement of profit and loss? So that was the first question, right? So first of all, in this transaction, there are two separate transactions. Number one, the event of happening a losses. Okay. So whenever there is a loss due to fire, that loss has to be provisioned. That loss has to be recognized in the statement of profit and loss. Okay. Number two, whenever it is virtually certain that the insurance claim will be received, it has to be shown as a receivable in the balance sheet and income in the profit and loss account. Right. Now, so we understood the income and the expense. Now the question was relating to the presentation, where it has to be presented, whether it has to be presented under exceptional item. If yes, whether it has to be gross or it has to be net, right? So talking about the exceptional item, and here I'll take the reference of Ind AS 1, presentation of financial statement. Ind AS 1 does not talks about the word exceptional item, while Ind AS 1 talks about that if the item is of unusual in nature and the amount is material, you have to disclose the item separately. If I correctly recall, para number 92, 93 talks about these aspects. But when I go to schedule 3, in the schedule 3, there is a specific line item where it talks about exceptional item, right? And drawing the analogy from our old accounting standard, which is AS, and with reference to schedule 3, if any such item which is not ordinary or not usual in nature, like event of losses is not usual in nature due to fire, right? It is unusual circumstances. So these kind of losses, if not material, it has to be shown under exceptional item, right? And since the insurance claim receivable is on account of these losses, and hence it has to be shown under exceptional item. But of course, under exceptional item, it has to be gross, and the relevant details has to be shown in the notes to accounts. You can look at a lot of companies' annual report, and I have seen Sun Pharma's annual report. They have a lot of exceptional items, right? So in the P&L, there is one line item, but when you look at the notes to accounts, there is exceptional item number A, B, C, D, E, right? So it's a gross. So that was from the presentation perspective. Number two, I think the question was, so if the company has not, if the company has not received the, if the company has not filed for insurance claim, right, then what is the accounting? So again, going back to my first response, when you recognize an income, it has to be virtually certain. But since you haven't filed for insurance claim, right? So in that case, since you haven't filed for insurance claim, so insurance company is not obligated to pay you those, insurance for the damages. And hence the income is not going to be recognized till the time you will not do your obligation. Number two, but if you think that it is probable that you will be able to receive that money, right? Then you can disclose this as a contingent asset in line with Ind AS 37. Now coming to the third aspect. So I think the third aspect was talking about, so what was the third question? Sorry.
It is how to account for such losses where at the year end, no claim has yet been filed with the.
Just how to account for those losses, right? So if it is a compensation received from the third party, right? So if there is a compensation received from the third party, again, so when there is a compensation which is received from the third party, that has to be shown as an income and the compensation receivable, and the damaged PP has to be de-recognized from the financial statement. And of course, when you de-recognize, of course, you have to record a loss in the statement of profit and loss. Likewise, for inventory, so you have to take this inventory to NRV, net realizable value. For example, 100 rupees inventory was damaged, and the NRV of this inventory is, let's say, 10 rupees. So 90 rupee loss has to be recorded in the statement of profit and loss. So the loss has to be separately recorded and the income has to be separately recorded. Thank you.
Alokji, just a follow-up question from my side, that in the year where the loss and the income are different, So that would mean that in the first year, in the year in which the fire has occurred, the whole amount would be shown as a loss as an exceptional item. And in the subsequent year, when the claim has been to be accounted for based on the certainty of the realization and the measurability, even that would it come as an exceptional income or that will come as a normal income? Because
Sir,
it would have an impact of the profits from a person who is referring to the financial statements, means the loss as an exceptional vis-a-vis income and in two different years.
correct, sir. Sir, in my view, of course, in the first year, when we took that item as an exceptional item, which is a loss in the first year, in the second year, we are getting that income just because we had occurred that loss. So in my view, that income has to be taken to the exceptional item.
Yeah. Now, going forward, my question is to Mr. Ganesan. Ganesan ji, you see, like when we issue the auditor's report, it normally addressed to those for whom the report is prepared, often either to the shareholders or to those charged with the governance of the entity whose financial statements are being audited. Suppose a company has undergone or undergoing corporate insolvency resolution process, CIRP, and the resolution professional has been appointed. Auditor's report in that situation, in that event, a company where the insolvency proceeding has been started, who should be the addressee of the auditor's report? Are there any other important aspects that needs to be taken care by the auditors while issuing the audit reports? That is the question for you.
Thank you, sir. And my sincere thanks to the FRRB for giving the opportunity of meeting all of you, as well as my fellow speakers, panelists, as well as the members on this important topic of common errors which we find in financial statements. And coming back to the question which you have mentioned, the report, audit report, when we are talking about as per SA 700, it's very clearly mentions that the report should be given to the person to whom actually appointed the auditors. So let us take the case of the company which is under CARP. The moment an interim resolution professional has been appointed, or maybe subsequently he has been replaced by the normal resolution professional, what exactly happens under the Companies Act because of the CARP, that powers of the board is vested with the resolution professional or the interim resolution professional, as the case may be. But he is not replacing the shareholders of the company. And accordingly, the provisions of the Companies Act relating to audit report will continue to be there. In other words, the report will be addressed to the shareholders of the company. But when the board meeting is not convened, we will be normally discussing the observations because there will not be any audit committee, there will not be any other committees of the board. So we will be discussing with the resolution professional of our observation. So that is the communication which we are giving to those charged with governance according to standards and auditing. But the audit report should be addressed only to the shareholders of the company and not to the resolution professional. If you are addressing to the resolution professional, it tantamount to, because he is replacing the powers of the board, as if the audit report has been addressed to the board of directors of the company rather than to the shareholders of the company. And accordingly, in my view, even if the company is under CARP and the resolution is taken over, the audit report should be addressed only to the shareholders and not to the resolution professional.
Thank you.
Okay. So now moving to Vivek ji. It's on Ind AS 105, Vivek ji, that where the notes to the financial statement, it states that the board of directors had approved the hiving off of X business during the current year. The discontinuing operations were excluded from the results of the continuing operations and were presented as a single amount as profit or loss after tax from the discontinued operations. However, the income and expenditure account of X business, depreciation and amortization expenses had been disclosed. So, in your view, does the treatment of depreciating and amortizing non-current assets of a discontinued operation align with the requirements of Ind AS 105?
First of all, thanks to FRB committee, chairman, vice chairman, for giving me this opportunity. In the given case, before going to 105, we have to also understand the requirement of Ind AS 16, property, plant and equipment, because Ind AS 16 specifically says that you can do depreciation begins when the asset is available for use. And I think paragraph 56 clearly states that the depreciation ceases to exist, ceases to at earlier of the date when the asset is classified as held for sale or the date the asset is derecognized. So one in the 16 specifically says that once the asset has been classified as held for sale, the depreciation has to stop. And similarly, in this 105 again specifically says in paragraph 25 that an entity shall not depreciate a non-current asset while it is classified as held for sale, because same is not available for use for business and the management has taken the decision that the operation will be discontinued. So in the given case, the charging of the depreciation amortizing the non-current asset is incorrect, and they have rightly classified the asset as held for sale, but the depreciation and amortization expense, which was still disclosed in the income and expenditure account of the discontinued business, is not in compliance with Ind AS 105. Therefore, as per Ind AS 105 as well as Ind AS 16, depreciation and amortization should not be charged for the asset which is held for sale.
Thank you very much. Now, moving to the next question, I'll request Alok ji for your comments. You see, like Ind AS 115, revenue for contracts with customers, the accounting policy on the revenue recognition states that the revenue from the sale of goods is recognized when the significant risk and the rewards of the ownership of the goods have been passed to the buyer, usually on delivery of the goods. This is the normal understanding. The question is, does the stated accounting policy, the whatsoever I have elaborated upon, this policy simply says rewards of ownership of the goods have been passed to the buyers on the goods when the significant risk and the rewards has been passed. Does the stated accounting policy on the revenue recognition align with the Ind AS 115, or does it reflect the principle of the erstwhile Ind AS 18? One more question with it. How do the revenue recognition principles under Ind AS 115 differ from those under Ind AS 18? This is the question to Alok ji. Before that, just to really we are so kind. Our Honorable Vice President is around us, CA Prasanna Kumar D. I'll really been so pleasure with his presence. Before your answer comes to me, I'll request my
No, actually, friends, I'll just tell you, I was invited when the inaugural was going on. I was held up in some other meeting. I just want to show my face to all of you. Wish you all the best. Have a great learning. That's what I came here. Thank you. Thank you. We carry on questions. I don't want to disturb the proceeding. After president speech. I told you, I was at some other meeting, that's why I could not shout. So I just want telephone out of the meeting. So amazing. Yeah, we'll be. Okay, thank you.
Yeah, Alok ji, over to you, sir.
Yes, sir. Yes, sir. Sir, thank you for the question. And when I talk about revenue recognition, so let me give you some context and then I'll come to the question. So this revenue recognition, earlier we had Ind AS 18 in line with the global standard IAS 18, right? And the title of the standard was, revenue recognition, that's all. But on 28th March 2018, MCA has notified the new standard in line with the global IFRS 15, which is IND AS 115. And the title becomes Revenue from Contract with the Customers. So if we look at the title and we compare the title, the idea was to cater all the revenues which belongs to all the industries in a standardized manner, right? And with that, they have given 5 steps, right? They talk about doesn't matter whatever is the industry, doesn't matter what is the segment, what is the product, what is the service. You have to measure, you have to weigh the revenue going by the 5-step model. Number one, you need to identify, is it a contract with the customer? Then you need to determine what is the performance obligation, right? And when I talk about Ind AS 115, it is less supplier, more buyer-centric standard, more customer-centric standard. So whatever goods and services you are supplying to the customer, whether the customer is getting benefit out of it, right? So the theme of the standard was under this fundamental. So once you have identified it is a contract, second, you determine what is your promises, what is your performance obligation. Then the third one is to determine the transaction price. The fourth one is you need to allocate the transaction price into the multiple performance obligation. And then you have to recognize revenue at a point in time or over a period of time. So these were the 5 steps which are given in Ind AS 115, which was not there in Ind AS 18, right? So today's reality is Ind AS 115 is applicable, which is notified by MC on 28 March 2018. Now coming back to the question and the accounting policy. The accounting policy says that the company has recognized the revenue because of, so there is a transfer of risk and reward for the goods and services, and hence the company is recognizing the revenue. So the question was whether this accounting policy is correct in line with Ind AS 115. Second, if it is not correct, whether this accounting policy is as per old standard Ind AS 18. Third, if yes, then what is the difference between the revenue recognition between Ind AS 18 and Ind AS 115? So I'll respond for all 3 questions in a single answer. Number one, the accounting policy is not appropriate because Ind AS 18 was talking about significant risk and reward transfer. And this accounting policy is in line with the erstwhile standard Ind AS 18, not in line with Ind AS 115. Number two, what is the major difference? So Ind AS 18 talks more about like our old accounting standard 9. So Ind AS 18 talks about the transfer of significant risk and rewards. But Ind AS 115 talks about transfer of control. For example, let's say I have sold a machinery to a customer, right? And that machinery is a very specific kind of a machinery where as a supplier, I need to provide a training. And if I'll not provide a training, the buyer or the customer will not be able to use the machinery, right? Since I have delivered the machinery is lying at the buyer premises, right? If there will be a theft, if there will be a damage, these all belongs to the buyer. So the question is whether risk and reward has been transferred. Answer is yes. Question number 2, since I have not provided a training and the buyer or the customer is not been able to use that machinery, so have I been transfer the control in respect to the buyer? Answer is no. Should I recognize the revenue with respect to Ind AS 115? Answer is no. So 115 is more customer centric standard. 115 has given a fundamental of, transfer of control rather than transfer of risk and reward. So this is the basic difference between these 2 standards. Thank you.
Thank you, Alokji, for very clearly bringing out the distinction between the 2 standards. And I think with this background, definitely the financial statements, the preparers and the auditors would have a relook at the policies that are being disclosed under the revenue section. The next question to Ganeshan ji, again continuing on the standards on audit, Ganeshan ji. The auditor has modified his opinion by giving a qualified opinion as well as a disclaimer of opinion. So is it appropriate for the auditor to issue both a qualified and a disclaimer of opinion together for one set of financial statement? And I know definitely, but you would cover that what are the difference between these 2 types of opinion and under which circumstances should each be issued? Over to you, sir.
Oh, thank you, sir. Very interesting question because when we talk about the 700 series standards and auditing, 700 on the format of the financial statement, 705 on the modification in the independent auditor's opinion, and of course 706 on where when we have to use the emphasis of matter or other matters paragraph in an audit report. Very, very clear guidelines has been given in the respective standards because this question is relating to a modification in the audit opinion where the auditor wanted to use both qualified opinion as well as disclaimer of opinion. The fundamental thing which we have to look at is what exactly is 705 talks about as a core principle. 705 says that there could be three situations of modification in an audit report, maybe a qualified opinion, or the auditor believes that the level of misstatements are actually very, very significant, and maybe the exact word which has been used in the standard is pervasive to the financial statement as well as material. And he was able to carry out and identify the uh, differences, that is material misstatement. Then he will go for an adverse opinion. The third is a disclaimer of opinion where the auditor not able to conclude whether the financial statements as a whole is free from material misstatement because there could be limitation of work or there could be a lot of uncertainties relating to the areas which he is asking for. In those circumstances, the auditor could not form an opinion. And in that case, the suggestion given in SA 705 is to think about disclaimer of opinion. Before going to disclaimer of opinion, because this particular scenario is talking about qualified opinion and disclaimer of opinion, before going to disclaimer of opinion, let me make it very clear. If I wanted to qualify my audit opinion, there should be certain parameters which has been very clearly mentioned. For example, the auditor is trying to obtain appropriate audit evidence, but on the basis of the audit evidence obtained, he concludes that the financial statement as a whole are materially misstated, are not free from material misstatement, whatever wordings which we can use. So based on the audit evidence obtained, he concludes that there are misstatements that are material to the financial statement. Then the next question the standard asks you, the auditor, is to exercise this judgment by looking at into the other matters. For example, it uses the word pervasive, whether the particular item is pervasive on the financial statement and whether it is material. This is the two conditions which we are looking for. For example, if the misstatements which has been identified by the auditor based on the audit evidence collected, or where the auditor is making an assumption based on the various judgment which he has made and based on his experience, the possible misstatement which he could not identify by because he is not able to get the sufficient appropriate audit evidence. In that case, the detected misstatements and undetected misstatements, which he presumes, whether put together, is not confined to one specific element or one account or one item of the financial statement, but it impacts the entire financial statements. Or maybe one item it is impacting, but the amount is substantial. For example, property, plant, and equipment, there is an impairment loss in accordance with the assessment made by the auditor, which will result in the company assuming that it has given the unaudited financial statement for the auditor with a profit, and the audit entry which the auditor believes to be past for impairment loss will make that as a significant loss. It's a clear example of pervasive case of misstatement and possible misstatement, whether detected or not detected. Now the question is, if it is pervasive and not and material, then what we have to do? When it is only material but not pervasive, what we have to do is the clear guideline available in the Standards on Auditing SA 705. What it says is the auditor has to make a qualified opinion if, after obtaining the sufficient appropriate audit evidence, concludes that the individual misstatements are the aggregate of various misstatements he has identified, maybe on purchases, maybe on sales, maybe on capitalization, maybe on expenses. He has identified various misstatements. The aggregate of the amount are material beyond the materiality fixed by the auditor as per SA 320. If it is only material, but it is not impacting the entire financial statement, or it is substantially impacting a particular line item, or an important disclosure is not being included in the financial statement, in that case only the pervasiveness comes. If the auditor concludes it's only material but not pervasive, the auditor is expected to issue a qualified opinion saying that, subject to my comments in the basis for qualified opinion paragraph, the financial statement give a true and fair view. So subject to is the word which he uses. He qualifies, or he makes a conditional statement on the opinion. Similarly, if the auditor believes that I cannot obtain sufficient appropriate audit evidence, but based on my experience as an auditor, based on my knowledge about the risk involved in the particular engagement, if the auditor concludes that the possible impact, not exactly identified impact, but the possible undetected misstatements, still it's only material but not pervasive, the auditor will be issuing a qualified audit opinion. But on the contrary, I will little bit touch upon on the adverse opinion. On the contrary, if the auditor, after obtaining sufficient appropriate audit evidence, concludes that the individual misstatements are the aggregate of the various misstatements he has identified is material as well as pervasive, then he has to issue an adverse opinion. So in the question, adverse opinion is not actually coming in, but I just wanted to make a small make a clarity on the reason why we have to consider adverse opinion and how it is differentiated by the disclaimer of opinion. In adverse opinion, after obtaining sufficient appropriate audit evidence, auditor concludes material and pervasive. Then he disclaims his opinion. But in a disclaimer of opinion, auditor could not obtain sufficient audit evidence. But the auditor concludes the possible effect of the undetected misstatements are material and pervasive, both material and pervasive, because he could not obtain sufficient appropriate audit evidence. It may not be proper for him to issue a qualified opinion. It is not proper for him to issue a adverse opinion. He has to only say, I'm unable to express an opinion, which is nothing but a disclaimer of opinion. And another possibility of disclaimer of opinion could be there are a lot of uncertainties, or there are limitation of the scope which has been imposed by the management. Auditor trying to talk to them and trying to remove the scope limitation, but they are not allowing him to do that. In that case, the auditor cannot form an opinion, so he makes a disclaimer. So for a qualified opinion, material but not pervasive is the condition. For disclaimer of opinion, I'm unable to obtain audit evidence, but based on my experience, the possible effect of undetected misstatements will be material and pervasive. I have to issue a disclaimer of opinion. Let us come to the exact case study which we have considered here as a part of the question. In this particular scenario, the auditor has made a disclaimer of opinion. That means the auditor has very clearly communicated that he could not obtain sufficient appropriate audit evidences, or maybe there are other uncertainties involved in that. So the moment he makes a disclaimer of opinion, he cannot include, because the moment I'm using a disclaimer of opinion, it is considered as material and pervasive. The moment I conclude that material as well as pervasive issue is arising out of the misstatements or identifiable misstatement or undetected misstatement, I cannot go and take a shelter on my qualified opinion, because in qualified opinion, if pervasiveness is existing, you cannot issue a qualified opinion. Accordingly, in the present case, my view is that the auditor cannot use both qualified opinion as well as disclaimer of opinion. Maybe I can even say auditor cannot use an adverse opinion as well as a qualified opinion. Auditor cannot use an adverse opinion as well as a disclaimer of opinion in the same audit opinion, because his judgment has to be very clearly demonstrated whether he believes it's material but not pervasive. Second, whether it is material based on audit evidence observed and also pervasive. Third, whether he cannot obtain audit evidence, but the possible misstatements are pervasive. He has to make it very clear. And accordingly, only one possibility, either qualified opinion or disclaimer of opinion, depending upon the circumstances. In the given case, the circumstances has not been very clearly explained, whether he is unable to obtain audit evidence. And accordingly, I believe that the auditor is incorrect to include both qualification as well as disclaimer of opinion in a single audit report as per the prescription and guidance given in SA 705. Moreover, if you see the opinion paragraph as per SA 700, the paragraph has to be changed as either qualified opinion or disclaimer of opinion or adverse opinion. Similarly, the second paragraph, basis for opinion, should also be changed to basis for qualified opinion, basis for adverse opinion, and basis for a disclaimer of opinion. So accordingly, very clearly guided by SA 705, auditor is incorrect to include both in the same audit report is what I wanted to communicate based on my understanding of the facts of the case. Thank you, sir.
Thank you, Ganeshanji. A very detailed response you gave, and I think that would have clarified a lot of aspects. In fact, we will not have to go back to 705 because you have explained in detail. But one thing I always consider as, just to distinguish between the qualified and the adverse and the disclaimer is the language that is expected to be used in the opinion paragraph. And I think that would very clearly distinguish, like whatever you said would summarize the whole thing. So when we talk of the qualified opinion, so we have the basis of qualification or the basis of opinion para that you mentioned. And so if in the opinion paragraph, if it is a qualified opinion, then what is expected that we should as auditors write is that subject to the above, whatever is in the basis of modified qualified opinion paragraph, the financial statements give a true and fair view. That is what is the qualified opinion. When we move to the adverse opinion, it says that because of whatever has been mentioned above in the basis of adverse opinion thing, the financial statements do not give a true and fair view. And in the third category, which you discussed at length on the disclaimer, where the auditor would opine that the auditor is unable to comment whether the financial statements give a true and fair view or not. I think these three, the English language itself would give a very, very clear picture about the three modifications that are there in the standard. So thanks for a very detailed explanation. Over to Chokji.
Thank you. Now the next question is with Vivek Agarwal ji. Vivek ji, there is a situation while reviewing the financial statement, there is a cancellation of the power purchase agreement. Whatever is been entered with the state government, that agreement is being cancelled while reviewing the financial statement. And looking at the another aspects, there was no addition to the assets for the last 2 years. The third situation comes in the interest due but not paid on loans taken from the parents is more than maybe 57% of the principal amount of the loan. Another position was like non-relation of the interest on the loans advances to the others. Both the situations are there. The company has a very minimal net worth compared to its liabilities. There is some kind of the uncertainty, and these material uncertainty creates doubts about this entity's ability to continue as a going concern. Now the question is, what is the disclosure requirement under this uncertainty situation under the Ind AS, when the material uncertainties whatsoever is being deliberated upon exist regarding its ability to continue as a going concern. My question is, what all is the requirement to disclose in the auditor's report and the financial statements also? Vivekji, over to you.
Thank you. Thank you, Chupji. Before discussing going concern, let's understand in today's scenario of IBC, going concern is one of the most important aspect. And I would also like to say that Ind AS 1, which governs going concern disclosure, paragraph 25, is one of the most neglected standard, if I can say, because it has got many uh, areas which is discussed in detail, but it is somehow overlooked by various finance controllers as well as auditors. And in the given case, when we say there's a basic understanding that all the financial statements are prepared on a going concern basis. And when preparing financial statements, in this one paragraph 25 states that there should be a use of going concern unless the management intends to liquidate the organization or cease the trading or has no realistic alternative but to close the business. And in those cases, the financial statement, if all these cases are not there, the financial statement must be prepared as a going concern basis. And when we talk about the disclosure requirement, if there are material uncertainties like given in the given case, like cancellation of power purchase agreement, we discuss about non-payment of loan interest, non-valuation of the receivables, minimal net worth, all this must be explicitly disclosed in the financial statement, as they can be some of the reasons or they can cast significant doubt on the entity's ability to continue as a going concern. And when the going concern basis is inappropriate, we have to disclose that the going concern basis has not been used and disclose the alternative basis in which the financial statements are prepared, like liquidation basis. And thereafter, provide the reason for this departure where the liquidation basis has been used. So whenever going concern basis is not used, the reason why going concern basis is not used, and if going concern basis is used and there are material uncertainty exists on certain areas, then why going concern has been used and how management has done the evaluation of going concern and came to a conclusion that the entity will be a going concern. And when we talk about going concern and reporting perspective, the auditor also has to report about the whether any material uncertainty exists regarding the entity's ability to continue as a going concern. And auditor has to refer to SS 570 and 230, because nowadays, if suppose we report that a company is a going concern and within 3 months or 6 months, the company goes to IBC and they say we are not able to meet our liability in near future, it becomes a very sticky situation for auditor also to explain how they had relied on the management evaluation and how they had done the documentation for the going concern perspective. So the requirement of SA 570 also comes in that, where it says that the auditor should evaluate the management assessment of going concern covering at least 12 months from the reporting of going concern is there, and determine the impact on the auditor's report if material uncertainty exists, whether the auditor has to report anything, and refer to the note which is given in such cases where material uncertainty exists. The auditor should refer to the note given in the financial statement while they are disclosing about the paragraph on going concern, material uncertainty which exists regarding the going concern. And the auditor should also document the procedure performed. And if it's a listed company or if the auditor is giving the key audit matters, they have to disclose properly that there were certain material uncertainty which existed on going concern and what are the procedures they have followed to document that they have made sure that the company is still a going concern, and they have evaluated the assessment done by the management and how they have proceeded with the other procedures which they have performed. And the judgments and the conclusion, how they have reached that, they should document that as per SA 230. And also a very important document is about the communication with the management and those charged with governance, what they have communicated and what reply they have got from the management in regard to the going concern. So the basis of preparation when going concern fails is about giving the alternative basis on which they have done the accounting and prepared the financial, and still when such material uncertainty exists and management does the evaluation and they prefer to move forward with a going concern basis, what were the uncertainty? How same was made sure that the going concern still exists and how the auditor has documented. Because we all should remember that in this ecosystem of IBC, every now and then companies are going to IBC, and we are also reporting in Caro about the company will be able to meet its liability in near future. All this aspect becomes very important to document, I suppose. That's all from my side.
Yeah, thank you, Vivekji. And in fact, I would just like to add over here that as one of the criteria for selection of enterprises under the FRRB that has been introduced from this year is that companies which go to IBC and in the immediately preceding year, if the auditor has not given any modified opinion or any thing under the material uncertainty regarding going concern, then those cases are being selected on a suo motu basis from the FRRB also. So just highlighting Vivekji, continuing what you emphasized on the auditor's responsibility with respect to going concern reporting in their audit report. Moving on to Alokji, it's a question on the employee benefits, and there are two parts to it. So the first part is that with respect to other long-term employee benefits, which includes the leave encashment. In the accounting policy of one of the companies, it was noted that the company has remeasured these benefits and the resulting gain has been recognized under other comprehensive income. So the question to this first part is that is it appropriate to transfer the remeasurement gain or loss of other long-term benefits liability or assets to OCI? The second part of this question is that in the notes to account on the employee benefit provisions, it was noted that the gain loss on actuarial valuation of defined benefit plans was transferred to OCI, whereas, so this was what was mentioned in the note, whereas on the review of the statement of P&L, it was observed that instead of being recognized under OCI, actually the company had recognized in the statement of P&L. So the question to this part with respect to the defined benefit plans is that is it appropriate to transfer the remeasurement gain loss of defined benefit liability assets to statement of profit and loss? And the third one, which is just trying to bridge these two, is that what can be the reason of such differential treatment, one to OCI and the other to the P&L? Over to you, Alok.
Yeah, thank you, sir. And very important point, and I can tell you, so on these two different aspects, people had, mistakes in the initial days when Ind AS was applicable to India. I am talking about the first year, which was 2016-17. And even we have seen that the management is, taking all the remeasurement gains and losses to OCI. Doesn't matter, is it on other long-term employee benefit or it is on, kind of post-employment benefit. So first of all, so one suggestion to the listener of this webinar, whenever you talk about presentation classification, so my biggest recommendation is don't stick to one standard only. For example, if something which is getting talked about on employee benefit, so I believe Ind AS 1 is the standard which you need to look at. Ind AS 19 you need to look at. And don't forget about the Schedule 3 also, right? And if you are on Ind AS, it is Division 2 to Schedule 3, which was notified on 6 June 2016. And if you are NBFC, which is on Ind AS, it is 11 October 2018, which you need to follow. Okay. Now coming back to the question. So the question, first of all, talks about the appropriateness of whether we can take this leave encashment, remeasurement gains and losses to P&L. Is it appropriate to take it to P&L? Number two, on the gratuity, or I would say defined benefit plan, right? Post-employment defined benefit plan. The remeasurement gains and losses, is it appropriate to take it to OCI? Number three, what is the reason for having a two different treatment? I believe this is the question. So now answering to this question, number one, What is remeasurement gains and losses? And for the larger audience, it is actuarial gains and losses. Whenever you look at actuarial report, there are three elements which is getting which we are taking to P&L. And when I say P&L, it is statement of profit and loss. A statement of profit and loss has two parts. One is profit and loss, which end up at profit after tax. The second part, which is second section, is other comprehensive income. And profit after tax plus other comprehensive income is equal to total comprehensive income. This is the structure of statement of profit and loss, right? So this remeasurement gain is actuarial gains and losses. And here we are talking about what should be the treatment of actuarial gains and losses, right? Now this employee benefit is split into four parts. Short-term employee benefit, your regular salary, your other long-term employee benefit like leave encashment, post-employment benefit like gratuity, and termination benefit, right? So when we talk about the actuarial report, when we talk about the projected unit credit method, this method is applicable to other long-term employee benefit and the post-employment benefit, right? So standard says that, and when I talk about the appropriateness, so appropriateness in financial reporting comes out from the compliance of the standard. What standard says? So standard says that if there is other long-term employee benefit, then please take it all the element, service cost, your interest cost, and your actuarial gains and losses to the P&L. Okay. So answering to Vishal sir question. So this leave encashment actuarial gains and losses has to be taken to the P&L in compliance with Ind AS 19 employee benefit. Talking about the gratuity, which is largely post-employment benefit plan, the actuarial gains and losses has to be taken to the other comprehensive income section, and the service cost and interest cost has to be taken to the profit and loss, the first section. Now the third question, what was in the mind of standard setter for having these two different alternate treatment? So probably if you look at the leave encashment, people are tend to have the leaves. Yeah, they are taking leaves during their employment. Okay. But gratuity you can only receive after your employment, once you leave the organization or once you retire, right? So this post-employment benefit plan or post-employment benefit, post-employment plans have a higher degree of uncertainty in comparison to the other long-term employee benefit, right? In comparison to the tenure, the post-employment plans are having a larger tenure in comparison to the other long-term employee benefit plan. So that was the reason why Standard Setter has opted for a different treatment. And they told that take everything to P&L if it is a other long-term employee benefit. Take for the defined benefit plan, take it to the OCI if it is actuarial gains and losses. So this was the considered view, in my view, while opting for this dual treatment for two different areas. Thank you.
Thank you very much. So now we'll be moving to the Ganesan ji. There is a situation in the financial statement. It has been observed that the company has classified its investment in shares under the inventories. It was further noted that the company is not registered as an investment company. So the question is like, is it appropriate for the company to classify the investment in shares as an inventory, or some other treatment the best as per the Ind AS required? Ganesan ji, over to you.
Very interesting question, sir. Very interesting question. Commonly, this confusion arises in everybody's mind. So let us look at this question in two perspectives, looking at two different standards. One is Ind AS 2 on inventories, and then Ind AS 32 on financial instruments. So first, let us look at Ind AS 2. Ind AS 2 in the scope itself says that standard applies to all inventories except financial instruments covered by Ind AS 32 and Ind AS 109. It clearly states that inventory excludes financial instruments. But at the same time, if you look at the paragraph of what is the definition of inventory in Ind AS 2, it says the items which are held for sale in the ordinary course of business. So if in the given situation, the company has been mentioned as it is a company which is trading in investments on a regular basis, because the case study has very clearly mentioned that the company is not an investment company. And accordingly, in the ordinary course of business, they don't hold the securities or the investment in other companies as part of their normal held for sale category. And accordingly, very clearly, we can say that it is outside the purview of Ind AS 32. Now, coming to Ind AS, Ind AS 2 inventories, it is outside the scope of Ind AS 2. Then, whether it will fall under Ind AS 32, we should look at the definition of financial instrument under Ind AS 32. Ind AS 32 very clearly says if a contract which gives rise to both financial asset in one entity, financial liability or equity instrument in another entity, then that is considered as a financial instrument. So in this particular scenario, when we were going further to the definition of financial asset defined to have cash, and the second item is any equity instrument in another entity. Very clearly defined, any equity instrument in another entity should be considered only as a financial asset. Accordingly, in the particular situation where the company is not in the ordinary course of trading in the investments, they cannot apply Ind AS 2. They should consider only Ind AS 32 financial instrument. And since the investment is in the equity shares of another entity, automatically it becomes a financial asset. The classification which the entity should apply should be investment in equity instrument of another entity. They can classify either under fair value through P&L category or under fair value through OCI category. Fair value through P&L is a normal scenario for equity instrument because when the classification comes in, we are looking into two aspects. One, what is the cash flow characteristics of the instrument? In the case, whether it is solely payment of principal and interest is the first question which we are asking for. In an equity instrument, there is no question of principal repayment by the entity and there is no interest payment. And accordingly, that first condition is not satisfied. SPPA test is not fulfilled. The second thing is what is the business objective of the entity to hold that particular instrument comes in. In this particular scenario, it is not as an inventory because their business itself is not there. And accordingly, we have to think about only fair value through P&L because both the conditions are not satisfied for classification as amortized cost model or fair value through OCI. It goes automatically to fair value through P&L. Having said that, there is one exception given in Ind AS 32 and read with Ind AS 109. An entity has an irrevocable option to designate any investment in equity instrument as fair value through OCI. Major reason is very simple, where a group company, where a parent company or another company is issuing, or maybe we will not consider as an associate entity or a subsidiary company. One entity is investing in equity shares of many other companies. The idea for them is not to have their P&L fluctuated with the fair value changes in the every quarter or maybe in the profit and loss account of comprehensive income. So they are given the option of taking it to the other comprehensive income statement. So in this case, it should be a financial asset, either fair value through P&L or fair value through OCI. If that irrevocable option of fair value through OCI has been opted for, even when the shares are sold and they have booked a profit, that profit should also be accounted only in OCI and not in profit and loss account because it comes with some stringent conditions. So to make a final summary, it should be considered as a financial asset and not inventory. And second thing is, most likely it will go to fair value through P&L unless the entity opts for classifying as an irrevocable option fair value through OCI. Thank you, sir.
Yeah, thank you, Ganeshanji. And I think this, I would say, classifying investments as inventories comes from our earlier AS2 and AS13, where we didn't have the standards on financial instruments. And that is being carried over, but very nicely explained to you that under Ind AS, that is not at all possible to carry investments as inventories. Moving to Vivekji. The accounting policy states that revenue expenditure that is incurred on R&D, research and development, it has been charged to the statement of profit and loss for the year in which it is incurred and the capital expenditure is included in the respective heads under property, plant and equipment. So revenue charge off to P&L and capital expenditure included in the PP. The question is that what is the difference in accounting treatment between research expenses and development costs under Ind AS 38, and whether this policy that has been stated in the financial statements is correct as per Ind AS 38.
Thank you, Vishalji. And this question of research and development becomes again very, very important with the startup ecosystem and the way accounting is happening in startup ecosystem. And then many of the startups are failing just because of their accounting practices which they are following. So research and development has been clearly there has been a policy which has been given uh, uh, in India's 38 about how research expense should be accounted and how development cost should be accounted. Research must be expensed off, whether it's capital in nature, whether it's revenue in nature, everything in research has to be charged to PL because it says that any expenditure incurred during the research phase of a project or for standalone research activity shall not be recognized as an intangible asset. It is charged to statement of profit and loss in the period in which it is incurred. This applies regardless of whether the expense is revenue or capital. When we talk about development cost, as per paragraph 57, it may be capitalized. The cost incurred during the development phase can be recognized as intangible, but there are some strict criteria which has to be met. What are those? There has to be technical feasibility of completing the asset. It should not be just a value-added product or something which has been thought of. It should be market ready, and there has to be technical feasibility of the completing the asset. The intention and ability to complete and use or sell the asset should be there. Whether the asset can be sold off or there has to be future cash flows arising from that asset. The probable future economic benefit, availability of the resource to complete the development, and the ability to reliably measure the expenditure. So when we say about key differences which is there in research and development, research costs are always expensed off and development costs can be capitalized if the outcome becomes very more certain and meets specific criteria. So when we say in the given case, the policy is not correct as it says that the research and development expenses uh, can be expensed off, and whenever there is a of capital nature, it is included in the respective head of PPE. So capital nature can only be capitalized when it is under development cost. It cannot be capitalized even if it is capital under research. So research cost affects the current period profit while capitalized during development cost. And if you see some of the examples which are there, like for research, like salaries of scientists, cost of testing various prototypes in the early phase whenever a startup is coming up, in like AI startups making various machine models and doing research, those costs has to be charged to PL. The edtech startups who are again training the models and the models have not trained and the models are not ready, all those cost has to be charged off to expense of, to the charged off to PL as a research expense. And when a model is ready or when the design and everything has been understood, then when the company starts developing it, that time it can be capitalized if the recognition criteria we have discussed above can be, which we have discussed earlier, has been uh, complied with. And cost like design and testing of the working prototype, software development cost, engineering cost, cost of registering a patent for development intention. So all this cost can be capitalized. So as I said, with the this standard on research and development has become very, very important in today's startup ecosystem. Startups at the early phase, to maintain the profitability, they have to take a very correct view that anything which is a research has to go to PL. And many startups I have met, they say, Vivek, if we charge everything to PL, what will happen to our PL? What will happen to our profitability? But we have to explain them that what is the requirement of these standards. And once the startup goes for funding and all, the due diligence which is there for accounting and the due diligence if they want to go for IPO and all, and it becomes very difficult if they don't follow this basic understanding of research and development. So in the given case, the policy is incorrect, and the research expense, whether the revenue or capital, has to be charged off, and development cost can be capitalized provided the necessary requirements of paragraph 57 has been complied with. Over to Vishalji.
Thank you, Vivekji. Now, my next question will be to Alokji. Alokji, there was a financial statement where certain material amount of the prior period items, errors are there, which has been recognized during the year. The question is, what is the accounting treatment of the prior period errors in view of the Ind AS 8? That is the question with you.
Yeah. Very important question, sir. And I can say that people are making an error in correcting how to correct an error, right? So this is one of the area where I will say, people are not making error because they want to make an error, but because they are used to, apply accounting standard, right? And accounting standard talks about don't restate whatever is there. So if you found or discover an error, just take the impact of the error and take it to the current year P&L as a prior period item, which is blessed by accounting standard, which is blessed by Schedule 3 also. Now talking about Indian accounting standard, which is in line with IFRS. So this Ind AS has a very stringent provision in terms of how to correct an error, right? So it is not only Ind AS 8, it is Ind AS 1 also. So when you read both the standards says that whenever there is a material prior period error, if the error is immaterial, it is not an error from the accounting and reporting perspective. But if the error is material, it is an error which requires the application of Ind AS 1 and Ind AS 8. Now, Ind AS 1 and Ind AS 8 says that if there is an error which is material, instead of taking the entire impact of the error in the current year, you need to restate your comparative also. It means you have to take an impact of the correction of the error in the comparative financial statement if error belongs to last year. But what happens if error belongs to 5 years back, right? Because you are preparing the financial statement for current year with a comparative year, okay? So if the error belongs to beyond comparative year, then you need to give a third balance sheet. And what is that third balance sheet? So this third column balance sheet is the opening date of the comparative period balance sheet. For example, current year is 24-25. Your comparative year is 23-24. So you need to correct your opening balances, which is 1st April 2023, right? And then from the date of error to 1st April 2023, you need to compute the impact. And whatever impact is applicable to any element of the financial statement, means asset, liability, equity, income and expense, correct that, right? Correct that in the third balance sheet. And this is how you need to correct your error, right? So accounting standard, very simple, retrospective calculation, but prospective application. Ind AS, retrospective calculation and retrospective application. So this is how the provision is stringent in Ind AS and IFRS in comparison to accounting standard. So now focusing on, again, since the accounting policy says that they have considered in the current year. So there is a difference in Schedule 3 also. When you look at Division 1 to Schedule 3, Division 1 to Schedule 3, there is a line item called prior period item. In Division 2, Division 3 of Schedule 3, there is no such line item of prior period item, right? So in Ind AS, you need to correct your error by restatement of the comparative and giving the third balance sheet and providing some disclosures. Okay, thank you.
Yeah, I think so. That is a very important, and like you mentioned that making errors to correct errors, and at the FRRB, our objective is to minimize errors so that the overall quality would improve.
Correct.
So moving on to Ganeshanji, I'll again stick to the employee benefits. In the financial statement that was reviewed by the board, so it was noted from the notes to account that various disclosures with regard to employee benefits have been made by the company, but the disclosure of expected contribution to the plan for the next annual reporting period, that has not been disclosed. So the question here is that whether this disclosure is required to be given. If yes, how should the management compute this based on the outstanding liability based on cash flows, based on liability less plan asset returns. So how should it be computed? And also whether is it possible that in case the plan assets are more than liabilities, means there is a net asset, still the disclosure for the expected contribution for the next year is required.
Again, it's a common error because in respect of a defined contribution plan, we don't have any such disclosure requirement. But if it is a defined benefit plan, a lot of extensive disclosures are expected under Ind AS 19, especially to make the user to understand what could be the possible timing on the cash flow which will happen in respect of the defined benefit plan outflows. So if we look at the various disclosure requirement, one of the paragraph, if I'm not wrong, it is paragraph 147 of Ind AS 19. It contains A, B, and C. The B is exactly what the board has observed in the particular scenario, that what is the expected contribution for the future or the next year is not disclosed. 147B specifically requires the entity to disclose in respect of defined benefit plan what could be the possible outflow of obligation in the next year. Having said that, there is a specific requirement that it's a mandatory disclosure as per the standard Ind AS 19. The next question which has been put forth is how management can compute this. The practical way of looking at this is any defined benefit plan will be automatically validated by unit, the actuarial valuation based on projected unit credit method. The best way is to ask the actuary to make a projection of what could be the implication or what could be the outflow which is required based on the position of the plan assets and the present obligation for the next year. And that could be the basis in which the outflow can be disclosed by the management. That is coming to the second question. Third question is very interesting. Suppose if the plan assets are much higher than the liabilities, that means there is no outflow which is going to happen, but the plan assets are already covering the existing obligation. So in the next year, there is not going to be any obligation. Whether the disclosure required is still to be considered. For that purpose, I invite the attention of the participants here. Paragraph 147A. I told no 147A, B, and C. See, A is saying a description of any funding arrangement and funding policy that affect future contributions. So, what will be affecting my future contribution? What is the fair value of the plan assets I have? That will affect. So, a disclosure, maybe by means of narrative, that there will not be any future outflow of amount because there is no obligation. But this is the reason that disclosure is also mandatory according to paragraph 147A in my view. So to answer, one, it is a mandatory requirement. Second, you can go for projected unit credit method, do an actuarial valuation, ask the actuary to project it for the next year and take that as the disclosure valuation. And the third is even if the plan assets is exceeding the plan obligation, still the requirement of paragraph 147 is coming into existence, and you have to explain why you feel that there is no outflow of resources. Thank you, sir.
Yeah, thank you, Ganesan ji. Now I'll be moving to Vivek ji. Vivek ji, in the annual report of a company, prepaid expenses have been disclosed under the other financial assets. The question is the classification of the prepaid expenses under the other financial assets is in compliance with the requirement of the Ind AS 32 and related therewith your guidance is requested. Over to Vivek ji.
Thank you, Chuk ji. Now, it has been a settled principle about financial asset and financial liability. Let's start with the definition of financial asset as per Ind AS 32. Ind AS 32 defines financial asset to include any cash, an equity instrument of another entity, a contractual right to receive cash or other financial asset, a contractual right to exchange financial instrument under potentially favorable condition. When we say prepaid expense do not meet this definition. They do not provide a contractual right to receive cash or another financial asset. Instead, they represent a right to receive service and hence they should not be classified as financial asset. Moreover, when we go to Division 2 of Schedule 3, Division 2 of Schedule 3 specifically and categorically says that prepaid expense should be classified as other current asset, not under financial asset. This aligns with the nature of prepaid expense as being non-financial in nature, and it is just a, a right to receive service. And therefore, with the understanding or definition of financial asset and simultaneous effect or simultaneous disclosure requirement of Division 2 of India Schedule 3, prepaid expense should be disclosed under other current asset and not under other financial asset. The correct classification of financial asset does not comply with Index 32, and therefore it's a non-compliance of Index 32 as well as Schedule 3, Division 2. Over to Chukji.
Thank you, Vivek for explaining with respect to the presentation of the prepaid expenses. Moving on to Alok sir, it was noted from the accounting policy on share-based payment that the company measures its stock appreciation rights, that is cash settled or equity settled share-based payment by using intrinsic value method. So the questions are, is the use of the intrinsic value method correct for measuring cash settled and equity settled share-based payments? If not, how should these share-based payments be measured as per Ind AS 102?
Yeah. So, sir, in Ind AS, we have Ind AS 102, a full-fledged standard on share-based payments, right? In accounting standard, we don't have an accounting standard, but we have a guidance note on employee share-based payments, which was revised in, if my memory is correct, in September 2020, I believe. So talking about this Ind AS 102, which takes care of share-based payments. So the accounting policy says that the company has used intrinsic value. Okay. Probably the company was used to follow accounting standard prior to Ind AS, and while they have moved from AS to Ind AS, but they haven't moved from the accounting policy per se, right? Because in Ind AS, it is a requirement is different, in accounting standard requirement is different, right? So Ind AS 102 says that whenever you do the cash settled share-based payment accounting or equity settled share-based payment accounting, so the measurement has to happen at a fair value, right? So fair value is a different from intrinsic value, because when you look at intrinsic value, it ignores the volatility aspects, it ignores the time value of money aspects, right? So that is not the right approach, that is not the right policy from 102 perspective. So both the plans has to be measured at fair value, right? Number two, what is equity settled? So it's more like an active voice or passive voice of a grammar, right? When you say equity settled share-based payments, means share-based payment which is settled in equity. End of the day, you will get the equity. When you say cash settled share-based payment where you get a cash on the basis of the equity price, right? So when it is a equity settled share-based payment, then you have to measure it on the fair value on the grant date, the date on which you are issuing a grant. Get the fair valuation done either on a Black-Scholes model or a binomial model. You will have a fair value, right? Then whatever is your vesting period, recognize it in P&L, in the employee benefit expense, and credit to the reserve, right? So equity settled share-based payment reserve. If it is a liability, you have to measure it at fair value on every reporting date, right? And take the impact into the P&L as an employee benefit expense, and the credit you have to take it to the liability, because this is a liability. So this is the typical accounting under Ind AS 102. And of course, intrinsic value is not the right approach. It's a fair value which has to be used. Thank you. I am done, sir.
Yeah. Thank you. Thank you very much. The next question comes in from Ganesan ji. There are the certain facts which has been observed from the financial statements that the cash outflow arising from the subsequent purchase of stake in subsidiary company has been reported as cash flow from the investing activities. The parent company is not an investment entity. The change in ownership does not result in loss of control. The question is whether subsequent purchase of stake in subsidiary company has to be reported as cash flow for investing activities or the financing activities. This is the question. Ganesan ji, over to you.
Okay, sir. Sir, this observation, again, I have seen that it's a common confusion everybody is having when applying Ind AS 7 on statement of cash flows. The reason is when we look at the definition of investing activity as per Ind AS 7 is defined as activities for the acquisition and disposal of long-term assets and other investment not included in cash and cash equivalent. Here, the long-term asset and other investments is little confusing for people as if anything which I am doing should be part of my investing activity. People are not applying their mind on looking at what is the differentiation which has been brought in respect of financing activities. Financing activities has been defined as result in changes in size and composition of the contributed equity and borrowings of the entity. When I'm saying contributed equity, there could be a possibility that that is an indication which has been given that wherever you are talking about an equity, don't look at a normal situation. In the given case also, it is very clearly defined that the company is not an investment company, and accordingly, it is not part of their operating activity. It is not part of their investing activity. So only problem which we are having here is we are only looking at the definition and thinking that this is an investment which we are making, but simply ignoring that there are other guidances which are given in Ind AS 7. For example, if I look at paragraph 40 of Ind AS 7, it says that an entity has to make certain additional disclosure, shall disclose in aggregate in respect of both obtaining as well as losing control of subsidiaries or other business during the period. So that means whenever you are losing the control or acquiring the control of the subsidiaries, you have to make a lot of additional disclosure. And in this particular scenario, when I have made only a further investment, so it is not a question of whether I have acquired control for the first time or I am losing the control. It is actually existing control is being maintained. So naturally, paragraph 40 may not be exactly applicable. But if I look at the subsequent paragraphs relating to the disclosure required as per the investment made in subsidiaries and other companies, one of the paragraphs says very clearly, 42A, cash flows arising from changes in ownership interest in a subsidiary company that do not result in loss of control shall be classified as cash flows from financing activity unless the subsidiary is held as by an investment entity. Since the parent company is not an investment company, naturally, we are seeing that this is an investment made in the subsidiary company and there is no loss of control. So the existing control is retained. So paragraph 42A will squarely apply. And accordingly, the disclosure under financing activity is the correct disclosure, not under the investing activity as being done by the reporting entity in the particular case. So that is my observation, sir.
Yeah, very rightly pointed out, Ganesan ji, that even in fact today also we were in our board meeting, there were some reviews where the cash flow is an area where there are a lot of observations. Overall, also, if you see in our publications of the FRRB, the commonly found non-compliances, cash flow would be one of the standard where maximum non-compliances have been observed, and especially the categorization between the operating, investing, and financing activities and the additional disclosure requirements. So moving on to Vivek ji, this is a case of a real estate development company where it has been mentioned in its financial statement that in other expenses, expenses like legal and professional charges, listing expenses and demerger expenses, and advertisement and business promotion expenses, they were transferred or capitalized to the work in progress WIP inventory in case of a real estate development company. So the questions associated with such type of accounting are, is it appropriate to capitalize these expenditures in the cost of inventories? If not, what is the rationale behind their exclusion? And second is, what kind of indirect expenses can be included or capitalized in inventories?
Thank you, Vishalji. And whenever we talk about inventory valuation and the cost which is required to be included, uh, the simple understanding is that any expense which is directly attributable to bringing the inventory to its present location or condition can be added to the cost of inventory. Now, appropriateness of capitalizing other expense in inventory when we talk about, if we see as per India's 2, paragraph 15 and 16, the cost of inventory should include the cost of purchase, the cost of conversion, and other costs incurred in bringing the inventory to the present location and condition. In the given case, expenses like legal and professional charges, listing and demerger expenses, and advertisement and business promotion expense typically are not directly attributable to bringing the inventory to its present location or condition, and they fall under administrative or selling expense, which Ind AS explicitly states should not be included in the cost of inventory. Hence, when capitalizing this expense in WIP is generally not appropriate, doing so overstates the valuation of inventory. But real estate industry again is a typical industry because suppose in a real estate company, a company is there in which the project is taken, and till the project comes to and nowadays with the partial completion method being as per India's 115 not being applied to the way it was being applied previously in the construction contract. Now there has been lots of hue and cry that there is good amount of expenses in administrative expense and selling expense, and how to make sure that the balance sheet looks good for the investors. And due to that, all these expenses like legal and professional charges, other expense, and listing expense or demerger expense and advertisement expense are being capitalized and taken to WIP. When we say expense which can be included in inventory cost, indirect expense can only be included if they are necessary to bringing the inventory to its present location, like any legal fees which is specific for the project in discussion, which is specifically to make the project happen or without which incurring which the project cannot move forward, then those expenses can be capitalized with proper scrutiny. And expenses like indirect expense which are related to the project directly and which are attributable to the project, without that the project cannot move or cannot take its shape, then those expenses can be capitalized, like legal expense incurred for the land title deeds when the project is going on and there has been a legal battle specifically to bring to make sure the rights of the project is taken care of, then those expenses can be capitalized under inclusion of any specific cost which is for the salaries of people at the project department, salary of the people who are on site working day in, day out. Such salaries which are directly again attributable to the project can be capitalized. And when we say about marketing expense, this marketing expense are being capitalized in real estate because there is again a contention from the real estate industry that Vivek, this brokerage expense which we pay every year whenever a flat is booked by a broker is a cost and which we cannot take to PL as per the matching concept also, because the sales are not being recognized. And how can we recognize this brokerage expense to PL? That is the reason why they were taking all these expenses to the WIP. So there's other school of thought which says that this brokerage expense we can take it as a prepaid, or we can just park it till the sales are booked, and then matching concept can be applied and the expense can be charged to PL. But definitely this cannot be taken to inventory. So it is not appropriate to capitalize these expenditures, and only on specific scenario, specific where the justification can be done, that without this the project cannot be completed, without this the inventory cannot be brought to the present location and condition, then the indirect expense cannot be capitalized. That's a simple understanding of a real estate industry.
Thank you, Vivekji. Thank you very much. Now, next I'll be moving to Alokji. Alokji, the situation is like the company has recognized deferred tax assets on carried forward business losses and the unabsorbed depreciation. The company has a history of incurring tax losses in the recent years. The question is, given the entity's history of recent losses, can it recognize a deferred tax assets arising from the unused tax losses or the tax credits? Another question is, if so, what are the disclosure requirement under Ind AS 12? Yes, Alokji.
Sure, sir. Sir, I would say deferred tax asset is one of the area where the company can increase its bottom line without increasing the top line, right? Because when you have a deferred tax asset, of course, you have an income before profit before tax, and it will lead to your profit after tax, right? So I would say this is one of the classical line item in the entire statement of P&L, right? So one way line item, I would say. So talking about the deferred tax asset, and when you recognize deferred tax asset, you are looking at the recoverability because you are recognizing an asset, right? So in our old AS22, when I compare with Ind AS, and why I'm comparing, I'll prove it. Okay. So in AS22, the concept was virtual certainty and convincing evidence when you were recognizing the deferred tax asset. But I would say in Ind AS, the recoverability concept is bit relaxed in Ind AS 12. It talks about probability. It talks about probable. If it is probable that you will be able to recover your DTA, you can create and recognize a DTA, right? That is what it is. In Ind AS 12, a DTA is recognized for deductible temporary differences, unused tax losses, unused tax credit, only to the extent it is probable that the future taxable profit will be available. So the threshold is probable. Okay. Now, as I told you, DTA is the area where bottom line will be increased without increasing the top line, and hence it requires more caution, more care when you are recognizing DTA. So in this policy, where it says that the company has a history of losses, right? So the company has a history of losses and company wants to recognize deferred tax asset. So one exception is given under Ind AS 12, and Ind AS 12 says that, listen, I have given you a relaxed criteria for recognizing deferred tax asset, but if you have a history of losses, in that case, you cannot recognize deferred tax asset until and unless it is supported by the convincing evidence, right? And there is a para 82 who says that if you are recognizing deferred tax asset in a situation where you have a history of losses, then you have to disclose two aspects. Number one, what is the amount of the deferred tax asset which you are going to be recognized? Number two, what are the nature of those convincing evidence which tells you that your future taxable profit will be available, right? So you have to disclose the nature of the supporting evidences and you have to disclose the amount of the deferred tax asset. Thank you.
Yeah, thank you. And I think so this is one area where you very rightly said that the true and fair view of the financial statements can go for a toss if not applied correctly. My question to Ganeshanji is that with respect to a PSU company, a public sector undertaking, there is a requirement that the directions issued by the C&AG under 143(5) of the Companies Act needs to be reported upon by the auditor as part of the auditor's report. So while reporting on these directions, in one case, it was noticed that the reply given by the management was also included along with the auditor's observations. So the question is that, is this right? Is management's reply on specified matters required to be included in the report?
Yeah. Sir, 143.5, in case of companies covered by a C&AG supplemental audit, like our company's auditor's report order, specifically asks for statement of facts on various classes. So when we are talking about a statement of fact and not expressing any opinion, is more or less saying that what is actually the fact of the case, and rather than explaining it by means of what is the reason behind that, etc., it's not relevant in my view. And accordingly, in the present case, the auditor's requirement is only to express his own uh, responses for the various classes covered under Section 143.5 of the Companies Act 2013. And if he has over and above that included the management reply, is it a correct approach? Is the discussion which we have to have. My initial feeling when you started talking about the management response reply has been included, I thought that instead of he gives a response, he has simply included the response given by the management. So if that is the case, it's completely not at all acceptable because it is the auditor's responsibility to talk about that. I deviate little bit on the scenario where he has expressed his views and also included the management reply. But I don't think that including the exact management reply will be appropriate. It is not warranted. But in case if the auditor is giving a statement of fact and there is some development based on the discussion with the management, the positive references can also be part of the responses given by the auditor is my personal view, because I take the view based on what is the uh, guidance which has been provided in respect of company's auditors report order 2003, as well as the updated versions. In all the class 21, wherever there is some subsequent development. For example, the company is took a term loan, and the term loans have been parked in a short-term fixed deposit. In that case, one of the clauses, whether the term loans have been utilized for the purposes for which it has been obtained, is not satisfied. So if I'm responding like that, it is not actually communicating the correct fact. Whereas because as at the year end, when I have received this particular loan and I could not give the advances, the surplus funds has been deposited in the bank account, is a positive or maybe an explanatory statement for the user to understand. Any relevant information which the user can understand, the actual fact can also be supplemented by the auditor. But it should be the auditor's view and not just the management reply. Management reply should be vetted by the auditor. If the auditor concluded that yes, he can also confirm that what management is explaining is acceptable, that should be part of his response. So just including the management reply is not appropriate, is my view.
Thank you very
So
much.
from my side.
Yeah, thank you. Now I'll be moving to Vivek ji. Vivek ji, the accounting policy on borrowing cost simply states borrowing cost directly attributable to the acquisition of fixed assets are capitalized as a part of the cost of the asset incurred up to the date the assets is ready for its intended use. Other borrowing costs are charged to the statement of profit and loss account in the year in which they incurred. This is the accounting policy which has been brought into in the financial statement. The question is whether capitalizing borrowing costs which are directly attributable to the acquisition of fixed assets is correct, and how to distinguish whether costs are directly attributable or not. The another question is define a qualifying asset in the context of the borrowing cost. Over to Vivek ji.
Thank you, Chukji. When we deep dive directly in the provision of borrowing cost and capitalization of borrowing cost as per Index 23, an entity shall capitalize borrowing costs that are directly attributable to the acquisition, construction, or production of a qualifying asset as part of the cost of that asset. So, in the given case, it is correct and in line with the standard. Capitalizing such cost ensures that the total cost of bringing the asset to working condition is reflected accurately. And when we say what is borrowing cost? Borrowing costs are considered directly attributable if they incurred specifically for the purpose of acquiring or constructing a particular asset. There's a clear link between the borrowed funds and the qualifying asset, like interest on specific project loans, finance charge related to this liabilities used to construct the asset. And when they are general borrowing, the capitalized amount is calculated using something called weighted average capitalization rate on expenditures made for the asset. And when we discuss what is a qualifying asset, a qualifying asset is defined as an asset that necessarily takes a substantial period of time to get ready for its intended use or sale. Generally, the property, plant, and equipment are most of the time the qualifying asset, like building and large scale manufacturing plants, investment properties under development, inventories that require long maturation period, that is like your real estate or wine industry or cheese industry. All these industries do fall into the qualifying asset, and interest are capitalized in inventory as well. Assets which are not considered qualifying are like ready to use equipment, or when you have simply purchased the machine and installed the next day. It cannot be a qualifying asset because there has to be a substantial period of time for the asset to get ready for its intended use or sale. And inventories which are produced on mass level on a very short cycle, those are also not a qualifying asset. A very important aspect comes in discussion about qualifying asset is that when should we stop capitalizing the borrowing cost? Capitalization of borrowing cost shall cease when substantially all the activity necessary to prepare the qualifying asset for its intended use or sale are complete. So in simple terms, we should stop capitalizing when the asset is ready for use or sale, even if it's not in use. And when we say ready to use, that is ready to use as intended by the management, which comes from directly in their 16. And for complex project and with multiple parts, capitalization may cease for completed parts that are ready for use. And there's one more important aspect which happens in real estate also, in other industry also, that is capitalization of borrowing cost should be suspended during an extended period in which active development is interrupted. That is, suspend capitalization if there's a significant abnormal delay in development, which and the delay is in the hand of the management. Like in the real estate industry, many a time it has been seen that a project is taken, a land has been purchased, management started the process of boundary walls and land filling, and they have stopped the project saying that there is some demand is not in the market. So we will initiate the project maybe after 2 years. For those 2 years, thus suspension of capitalization of borrowing cost should happen, which is ignored sometimes in various companies which we came across in our practical life. And in the given case, the management is correct when they are capitalizing the borrowing costs, which are directly attributable to the acquisition of the fixed asset. So that's all from my side.
Thank you, Vivekji. I would just like to share over here that, friends, till now, we are almost at 5 o'clock. And we have, it seems like a CF final exam paper that 1 hour is left and we've just completed 1/3 of the total questions. So, but I don't want the panelists to speed up the process because I believe that the response that we are getting from the participants is very encouraging, lot of questions. And let me assure you that if we are not able to complete today, maybe with the permission of the speakers, we'll come up with the part 2 of this immediately in the next week. But we don't want to compromise on the quality and the of the deliberations that we are having. And one question which we have got from a number of participants is about the availability of recording of this particular webinar.
Sure, sir.
Yes, it would very much be available, and I would request all the participants that we do have a X handle, a Twitter handle, where we will upload the link from where the recording can be made available, as well as the details of the next webinar. If we are supposed to host that in the next week, then that also. So please do follow us on the Twitter handle. So moving on to the next question for Alok ji. Again, Ind AS 19, I don't know, the office somehow feels that this is a standard where I am look pretty weak in, and therefore all employee benefit related questions have been shared to me and not to Chuk sir. So, Alok ji, the question is that as per the accounting policy on employee benefits, the company's employee gratuity fund scheme is a defined benefit plan, and the present value of the obligation under such defined benefit plan is determined on an estimated basis. Further, it was stated that the company has not received the actual valuation report for the year end. Hence, it recognized the provision for gratuity based on the premium demanded by insurance company. So the questions are that is it permissible under Ind AS 19 to recognize a provision for gratuity based on the premium charged by the insurance company? If not, how should it be recognized?
Sure, sir. And I'll answer this question in a very lighter manner. So there is a standard on auditing, which is 620, which says that using the work of an experts, right? So I believe in this question, who will be that expert? Is it actuary or is it LIC, right? I think there is a big difference. So if I talk about Ind AS 19, the policy is not right. So we cannot, we cannot create the provision for gratuity on an estimate basis, which is given by LIC. Ind AS 19 mandates that you have to apply projected unit credit method, right? So when we talk about projected unit credit method, so we only knows that actuarial has to be there. There is an actuary who do the actuarial valuation. We are looking at the report and we are just copy pasting the numbers. What is my defined benefit obligation table? What is my plan asset table? What is my experience adjustment table, right? So we are just copy pasting the number and the sensitivity assumptions and all, right? So while the copy pasting is okay, and if you want to verify the actual report, I can tell you 50-60% you can verify also with the limited knowledge even, right? So Ind AS 19 talks about the projected unit credit method, which is largely an actuarial valuation. It says that whenever you are recognizing your provision for gratuity, I mean to say this defined benefit plan, post-employment defined benefit plan, in that case, you have to get the actuarial valuation done. You have to apply the projected unit credit method, which takes into the consideration your salary escalations, your retirement age, your attrition rate, mortality assumptions, right? Your attrition in attrition rate in the company. So while taking all these assumptions, the actuary or the expert will arrive at what should be my gratuity provision at the end of the year. And then the gratuity provision has to be discounted back to the reporting date, and hence it is known as a present value of defined benefit plan, right? So these all assumptions are required, and consolidating and aggregating all these assumptions, the method will be called as a projected unit credit method. And who applies this method? Actuary apply this method, and the activity which actuary is doing, it is known as actuarial valuation, and which is required by Ind AS 19. So taking the LIC assumption, making a provision is of course not right as per Ind AS 19, and applying the actuarial valuation and then getting a provision, of course, that is a right approach as per Ind AS 19. Thank you.
Thank you, Alok ji. Now I'll be going to Ganesan ji. Ganesan ji, it was noted from the notes to the financial statements that loans and advances to parties and advances to employee have been classified under the other financial assets. The question is whether classifying loan and advances under the other financial assets is correct. Under which head it should be classified if otherwise, and is advances to employees a financial asset or a non-financial asset? Please explain that also. Now over to Ganesan ji.
Okay, this is also normally a concern for understanding for many of the people are believing that loans and advances drawn from old Schedule 6 means the same. But in this particular example which you have given, I am actually finding three different items. One, loans given to parties, advances given to parties, and salary advances given to employees. There are three items which I am looking at. In AS 32, when we were defining the financial asset, as you seen in the previous question which I have answered, the financial asset, when we were talking about, it should always result in settlement. uh, it should be a contractual right to receive cash or other financial asset from another entity or exchange a financial asset with a financial liability of another entity. This is a normal example or normal definition which we are looking for. In other words, a contractual right which will be settled by cash or other equivalents will normally be covered by financial assets category. So in this particular scenario, when I have given a loan or the entity has given a loan, the loan will be repaid along with interest, maybe according to the schedule of repayment prescribed in the terms and conditions of that. So it falls within the category of a financial asset. Whereas advance given to the others, say for example, it's a purchase advance which I have given to a party, or an advance given for purchase of a fixed asset by a party. In both the scenarios, I'm not going to get back another financial asset, or it is not going to be settled by another financial asset or exchange of a financial liability. It is actually receipt of services or receipts of goods. So any advances given for receipt of services or receipt of goods are not covered as financial asset under Ind AS 32. So naturally, any advances given to third parties or which is not in the nature of loan, and similarly any salary advances given to the employees are contractual right to receive services or to receive goods which are not covered under the definition of financial asset. And in this present question which you have posted to me is that loans has to be classified as financial asset because loans as per Schedule 3, separate line item is there in Schedule 3 as well. And accordingly, we should show loans separately. The advances paid to others, which is not in the nature of loans, as well as advance to employees, have to be classified under current assets or under non-current assets, depending upon what is the estimated date on which it will get adjusted. For example, if it is going to be adjusted within 12 months from the end of the reporting period, then it will fall under the current asset category. In all other cases, it will become a non-current asset. But surely it will not be considered as part of financial asset at all. Okay. So not only advance to employees, but also advance to others for supply of goods also, it's not covered under financial asset stand. They classified as financial asset. So I think I have made it clear.
Yeah. The next question to Vivek ji on deferred tax, Ind AS 12. Deferred tax liability has been recognized and measured based on depreciation expense as per books of account and tax depreciation. This is what has been mentioned in the policy of a company. So the question is that under Ind AS 12, deferred tax needs to be computed using the balance sheet approach. One of the most common items of deferred tax is property, plant, equipment, and the depreciation thereon. So could you explain how and where the differences in amounts can result between the P&L approach and the balance sheet approach?
When we were discussing cash flow, you rightly said that in the FRB reports, most of the points are about cash flow. And we feel after cash flow, if there's an area which is most incorrectly understood by financial controllers and we have to discuss in detail in audit committee is deferred tax. So when we say about deferred tax, uh, earlier accounting standard or IGAP used to talk about the PL approach, whereby the timing difference for the year as per income tax or timing difference for the year as per profit and loss account were taken, and the timing difference was compared and the deferred tax was provided. Under Ind AS 12, deferred tax must be calculated using the balance sheet approach, not the PL approach. When we say so, what is the key difference? The key difference is that in balance sheet approach, which focuses on temporary difference between the carrying amount of an asset or liability in balance sheet and its tax base. That is nothing but the WDV as per books and WDV as per tax. And the deferred tax is recognized for all the temporary differences unless exceptions apply to that. So for property, plant and equipment, if the carrying amount, that is book value, the WDV value as per book, and the tax base, that is the WDV as per tax, differ due to differing depreciation rates or methods, the difference is recognized as a deferred tax asset or liability. And when we say about PL approach, it is nothing but the timing difference for the year. So Vivek, both will give us same answer. What is the difference? There are several times non-taxable items or non-PL items which lies in the balance sheet, like revaluation of the accounts, revaluation of the PP, and that will not be calculated when we take the PL approach. So when we talk about discrepancy, which may arise, say a machine is there with a book value or purchase value of 1 lakh rupees, and the book depreciation for the year is 20,000, and income tax depreciation is 30,000. So when we take the book value method, the tax base is 70,000, 1 lakh minus 30,000 tax depreciation as per income tax. And carrying value as per book is 80,000, that is 1 lakh minus 20,000 as per books. So the temporary difference is 10,000. And for simplicity, let's say tax rate is 30%, 3,000 is deferred tax. And when we recognize this 3,000 as deferred tax liability under balance sheet approach. But when we go for PL approach, during the year, there may be sale and purchase of plant and machinery. During the year, there may be foreign exchange fluctuation, which may be allowed as a cost of asset in books, but not in income tax. All these aspects used to create a lot of difference. And although many of the finance controller was following the PL approach, they used to try and do a reconciliation from the balance sheet approach, at least for fixed asset or PPE, because there used to be a big gap when there was sale of an asset, when there was foreign exchange fluctuation, which was allowed to be capitalized as per books, but not as per income tax until paid. So all this created lots of differences. And to standardize as per international practice, this balance sheet approach was brought in. And thereafter, in this balance sheet approach, it will be cumulative effect. So suppose in a specific year, if the finance controller used to forget to create deferred tax in the PL approach, with this balance sheet approach takes a complete control, a complete recognition of deferred tax because it takes the total base. So that is the key difference, and the chances of deferred tax calculation going wrong becomes limited when we go for balance sheet approach compared to the PL approach. In the given case, the management has continued with the erstwhile IGAP policy, where they have said that the deferred tax has been recognized and measured based on the depreciation expense as per books of accounts and tax depreciation. This is not in line with Ind AS, because Ind AS specifically says that it should be calculated using the balance sheet approach and not the PL approach. Thank you.
So I appreciate Vivek, and just to extend it further with my experience, especially with respect to the result of the quantification of the deferred tax, a very important element between the two, and especially this I had observed, especially at the time of transition when we were doing from the IGAP to the Ind AS, was the effect of the change in the tax rates. Because what used to happen in the P&L approach, every year we used to find the difference between the depreciation as per PL and the as per the tax computation. And that difference, we used to apply the tax rate of that particular year. So we used to have like an opening balance of the deferred tax asset or liability, the movement following the P&L approach, and whatever were the movements that we used to compute or calculate the deferred tax based on the tax rate prevailing for that year, used to add to the opening balance and then carry it forward to the next year. So in case there was normally that is what we've seen in India, a decrease in the tax rate, especially corporate tax rate as compared to the earlier years, the effect was not given to the opening balances, which were already continuing as part of the deferred tax. Whereas in the balance sheet approach, what I understand, that when we take as at number, all the cumulative, I would say, differences with respect to tax rate of the earlier years and everything that gets adjusted through the P&L in the year in which there is a change in the tax rate, and therefore that gives a true and fair view of the presentation. So anything you would like to add to this, Vivekji, or anybody else for that matter?
Yeah, Vishalji, just to add on that, as I said earlier also, theoretically it used to say that we used to take for PL approach, but the WTV basis reconciliation was always done. So whenever the substantially enacted tax rate was changed, the cumulative effect to large corporates we were giving when we were doing the accounts as per IGAP also. So some of the corporates obviously found when they went for transition that there was a change or there was a substantial impact of the deferred tax. But erstwhile also corporates used to follow the WTV approach for reconciliation. And when we used to get the reconciliation done, then this substantial enacted tax rate was getting somewhere affected in the effect was being taken in the financials in IGAP financials, which we used to do that time.
Right. Thank you.
Thank you, Vivekji. Now I'll go to Alokji. Accounting policy states that financial assets are subsequently measured at FVT OCI if it is held within the business model whose objective is achieved by collecting contractual cash flow. The question is, does the classification of the financial assets as FVT OCI is in the given accounting policy comply with the Ind AS 109? Can you identify the situations where the financial assets can be subsequently measured at the FVT OCI? This is the question with you.
Right, sir. So while the concept of FVT OCI has also, also explained by Ganeshan sir, but let me reiterate and give my views also. So in Ind AS 109, when I talk about financial asset, the financial asset has been classified into three parts, right? So the accounting depends on the classification. The classification is depending on the business model and the cash flow characteristics. So when I look at the accounting, I need to look at my classification and I need to look at what is my business model, what is my cash flow characteristics. So there are three classes of financial asset. One is amortized cost, a fair value through profit and loss, and fair value through OCI, right? So whenever the financial assets, the company has a business model of keeping financial asset for receiving the contractual cash flows and for selling the financial asset, right? So the objective is both. If the objective is only to collect the contractual cash flow, it will be the amortized cost category. But if the objective is only for the trading, it will be FVTPL. But if the objective is to collect the contractual cash flow as well as to sell the asset, if both the objective is there, both the business model is there, and it is also meeting the SPPI test, means that financial asset is also giving you the contractual principal and interest as well, right? If these two conditions are meeting, this will be classified as fair value through OCI. So now coming back to the accounting policy, I will not say this accounting policy is wrong. I will say that this accounting policy is incomplete, right? The accounting policy says that the management has explained that the financial asset there are those financial asset which is recognized as a FVT OCI, which gives you the contractual cash flows, while the policy should be the financial asset FVT OCI should be those financial asset where the business model is to collect contractual cash flows and the selling the asset both, right? The second one is it should meet the SPPI test. So this will be the complete accounting policy. Talking about the situations of FVT OCI, it could be a debt instrument, it could be a equity instruments. If it is a debt instrument, of course, the business model and the cash flow characteristics both should meet. Business model means collecting cash flows, contractual cash flows, plus it is and not or, collecting contractual cash flows and selling the asset. You can get the money either by collecting the cash flow or by selling the asset in between. Okay. Second, it should meet the SPPI test, right? It is for the debt instrument. What about the equity instrument? Equity instrument by nature has to be classified as a FVTPL, right? Because equity instrument does not have a maturity. You cannot say that I'll collect the contractual cash flows from equity. So equity instrument does not gives you contractual cash flows, and hence it is neither amortized cost nor FVT OCI. So by design, it is FVTPL. So now, if you have a strategic investment, right, long-term investment, okay, so in that case, the management has an irrevocable option. If the management wants to designate this equity investment as a FVT OCI, the management can designate that, right? It's an irrevocable option. The only exception is if that equity investment is for the trading purposes, then they cannot designate this as a FVT OCI. And if this equity investment is coming out of a contingent consideration from the business combination, so there is a business combination and the equity is in the form of the contingent consideration in the hands of a recipient, then in that situation, the recipient does not have an option to classify that equity investment as a FVT OCI. So there are two exceptions. By design, equity investment is FVTPL, but management can designate it irrevocably at FVT OCI. But in two cases, the management cannot designate it at FVT OCI. One, if it is for trading purposes. Number two, if it is contingent consideration. Thank you.
Yeah, thank you, Alokji, for a very detailed way of explaining the classification, and especially in the financial instruments, we've seen that coming up as a challenge many times. The next question to Mr. Ganeshan is that in one of the reviews, there were certain facts that were observed from the financial statements. One was that the advance given for purchase of freehold land, which was given to third parties. There were advances that were there. And the movement or change in the balance of the capital advances was adjusted as working capital changes under operating activities. So whether this is the right way of presenting the true and fair view of the cash flow statement.
Okay. So first of all, an advance paid for purchase of a freehold land is for investment purposes. So it's covered under property, plant, and equipment. So naturally, it is an investing activity. It is not part of the working capital changes. For example, if it is an advance paid for any other activity, it may be loans and advances which we will cover for the working capital changes adjustment. So the investing activity where we were acquiring any property, plant, and equipment, we will show the outflows on purchase of property, plant, and equipment, net of capital creditors movement, net of capital work in progress, net of the capital advances. So all put together is what we normally disclose on a net basis under investing activities and not to adjust against the operating activity. So because if you are adjusting as a working capital, as an adjustment to working capital, it is shown as part of the operating cash flows, which is completely incorrect. And accordingly, the approach which has been made by the company is totally incorrect according to Ind AS 7. That is my view, sir.
Thank you very much. Thank you, Ganeshan ji. Now I'll be going to Vivek ji. Vivek ji, as per the note on EPS, earning per share, total comprehensive income for the year was taken as a numerator for computation of the basic earnings per share. The question which comes is it appropriate to use total comprehensive income as the numerator in the calculation of the EPS? And if not, what should be the numerator for computation of the basic earning per share as per the Ind AS 33? Vivek ji, over to you.
As per Ind AS 33, the numerator for basic earning per share must be profit or loss from the continuing operation attributable to the ordinary equity shares, ordinary equity holders of the parent entity, and the profit and loss attributable to the ordinary equity holders of the parent entity for the period. So, this requirement of paragraph 12 of Ind AS 33 clearly excludes other comprehensive income component which are included in total comprehensive income. So, as per question 1 of yours, is it appropriate to use total comprehensive income as the numerator in the calculation of basic EPS? No, it is not, because the total comprehensive income includes other comprehensive income, and paragraph 12 is crystal clear that profit or loss from continuing operation attributable to the ordinary equity shareholders of the parent entity and profit or loss of the ordinary equity holders of the parent entity for the period has to be taken for calculation of EPS. And as per the question 2, what should be the correct numerator for computation of the EPS? As already discussed, that the profit and loss attributable to ordinary equity holders of the parent entity, which means net profit or loss after tax for the period, excluding OCI items, and which is attributable to the ordinary equity shareholders, meaning that anything pertaining to, say, preference share, dividend, which is convertible into equity shares, and all those which is only attributable to the ordinary equity shareholders should only be taken for calculation of the EPS, and the OCI should be excluded. So in the given case, where TCI, the total comprehensive income, was taken for calculating EPS, it was not correct and non-compliant with the requirement of Index 33. Thank you.
Yeah, thank you, Vivekji, and very rightly mentioned that it was not appropriate to take the TCI. The next question to Alokji, and again, Alokji, this is something where we say that the playing around with the words, or maybe understanding or not understanding the differentiation between certain terminologies, which are of a technical nature, especially when we talk of the Ind AS. And this was the experience that we also had at the board in one case, where the note on investments, it states that the company had invested in equity shares of a commercial cooperative bank, which was measured at cost. At the same time, in the note on the fair value measurement, it stated that the investment in the commercial cooperative bank was measured at amortized cost. So the question here is that whether the terms cost and amortized cost are similar. Is it correct to classify an equity investment at cost in one disclosure and amortized cost in another? Do these terms refer to the same measurement basis? And the last question on this is, how should investment in equity shares, other than in the group companies, be measured as per Ind AS 109?
Yes, sir. Yes, sir. Talking about this particular situation, and you are right, sir. So basically, even I have seen in some accounting policies when there is an investment in non-group companies, and in the accounting policy, it was captured as that investment has to be measured at cost, right? So of course, talking about whether this investment is measured at cost or amortized cost, is it a right accounting policy? Answer is no, right? This is inconsistent and incorrect. So investment cannot happen at cost or amortized cost in accordance with Ind AS 109. There is only one exception which is given in the Ind AS 27 in the separate financial statement for investment in the group companies. And when I say group companies, I mean to say that subsidiary, joint venture and associates, right? Ind AS 27 says that, if my memory is correct, it's para number 10. It says that the investment in subsidiary, joint venture and associate in the separate financial statement has to be measured either at cost or at fair value in accordance with Ind AS 109. That is for the group companies. Now talking about the non-group companies, investment in accordance with Ind AS 109 has to be either classified at FVTPL or FVT OCI, fair value through P&L and fair value through OCI. If it is fair value through so by design, equity investment are fair value through P&L, right? By choice, you can take it to the OCI also, right? And again, as explained earlier, so the management can make a irrevocable option. The management can opt for taking it as a FVT OCI. Either it has to be TPL or it has to be FVT OCI, right? Cost and amortized cost is not the same criteria. While it is not allowed for equity instruments, it is only allowed for the debt instruments, that amortized cost. Now, what is the technical difference between the cost and amortized cost? So in my limited understanding, I can say that the cost is something which you are paying for acquiring an asset. Like the cost is used in Ind AS 16, property, plant and equipment, 30 investment, in 38 intangible asset, 40 investment property, what you are paying for. But when you talk about amortized cost, so amortized cost reflects that it is applicable for debt instrument, and it reflects the, I would say, the reconciliation between the present value of the discounted cash flows, your as on date amount versus what you are paying in the life, right? So when you apply the effective interest rate, you get a amortized cost of that instrument at the initial recognition. Okay. So both cost and amortized cost is not the similar terminology. They are different. Investment cannot be measured at either cost or amortized cost. That is number two. And in accordance with Ind AS 109, either it has to be FETPL or it has to be FETOCI. By design, FETPL. By choice, FETOCI. Okay, thank you.
Just to add what Alokji has mentioned, the standard is also very clear that even at the initial recognition, all the financial assets and financial liabilities are recognized at fair value. And the day one profit or loss should also be recognized in accordance with the respective standards. So naturally, the cost model may not be applicable for financial instruments at all.
Thanks. Thank you, sir. Thanks for adding.
Thank you very much. Ganesan ji, now I'll be coming to you.
Yes, sir.
Yeah, it was noted from an independent auditor's report as well as notes to the financial statement of the company that the company has branches, including foreign branches also. And the auditors considered the report received from the branches during the audit. However, the auditor has not provided the details of the branches that were not audited by him under the other matters paragraph. The question is, what are the responsibilities of the principal auditor regarding the branches that have not been audited by him? Another is there any requirement to report the financial figures of the such branches in the audit report by the principal auditor? Now, Ganesan ji, over to you.
Sir, I will consider that specifically in accordance with SA 706, which talks about emphasis of matters as well as other matters paragraph in an independent auditor's report. And I will also touch upon a little bit SA 600, maybe a point of debate which is going on at this point in time, because we are talking about what is the responsibility of the principal auditor. So we will touch upon that also a little bit. When we look at SA 700, it talks about the format of the audit report, including what are all the considerations to form an opinion. That is SA 700. SA 705 very clearly talks about when the auditor modifies the audit opinion, what are all the things he has to consider, whether it's a qualification, disclaimer, or adverse opinion, what are all the circumstances and how the paragraph should be made. And yet another standard on audit report comes as SA 706, when the auditor has to include an emphasis of matter or whether the auditor has to include an other matters paragraph. Here we have to be a little clear on what is the difference between an emphasis of matter paragraph and an other matters paragraph. The emphasis of matter paragraph is included by the auditor where he wanted to emphasize a matter which was already included in the financial statement. So for example, if there is a note explaining a particular item which is under a debate or whatever, for example, a huge tax demand based on the advice received by the entity, no provision has been made, no disclosure of contingent liability has been made. The auditor maybe wanted to emphasize that particular point, but very clearly states that without qualifying our opinion, we draw attention to note number so and so. But what we have to understand here is emphasis of matter comes into the picture if it is already part of the financial statement. I wanted to emphasize or I wanted to draw the attention to the particular matter. On the contrary, other matters paragraph, where the auditor wanted to bring certain matters to the attention of the users, but those matters are not part of the financial statements, even as notes on accounts, etc. But he wanted to bring the attention of the users, then he has to use other matters as part of his audit report. A lot of instances which has been explained where the auditor has to use the other matters paragraph in the application guidance of SA 706. One of the area is that the user is relying on independent audit report issued by maybe I should say the principal auditor. So accordingly, the user should be made known that the auditor has not audited certain branches. the auditor relied on the audit carried out by the branch auditors. So the expectation is that he has to mention how many branches have been not audited by him, but he relied on the audit report issued by the branch auditors. What is the quantum of the revenue relating to those audited by the branch auditors? What is the quantum of the assets relating to that particular item, particular unaudited results, and what is the cash flows, net cash flows relating to that particular unaudited, or sorry, audited by the branch auditors. It is a requirement to disclose in the main audit report. If you read this requirement along with the SQC 1, Standard on Quality Control 1, you will also understand that because the overall responsibility lies with the principal auditor, it is expected that the principal auditor should audit at least major portion of the revenue, major portion of the asset, major portion of the cash flow. Some of the firms are having a threshold limit of if we are not auditing 70% of the branches, we will not be able to issue a report. That they are also extending to parent company where they are the auditors and subsidiary companies are audited by somebody else. Even for the consolidated financial statement, they are saying that minimum we have to validate consolidated revenue of 70 to 75%, etc. This is firm to firm. What is the percentage which they are talking about is mainly because one of the learning which we had internationally is that if something goes wrong in the branch and the auditor simply says that it was the responsibility of the branch auditor to bring it, I relied in so far as the branch is audited by another auditor, acceptable as per SA 600 in the present scenario as approved by MCA. But having said that, you know that there is a big debate or big argument which is going on in respect of SA 600, where internationally the overall responsibility lies with the principal auditor. He cannot simply say that I relied on the work of the branch auditor, and if something gone wrong in the branch, I am not responsible. You cannot say internationally. That is what ISA centered. The NFRA is also trying to take the same stand by saying that your independent audit report is relied on the users, and accordingly, it is your own responsibility to look into the aspects of audits covered by the branch auditors as well. So, yeah, accordingly, since the new development is expecting that the principal auditor should talk about even the areas where he is not audited, but audited by the branch auditors, look into the critical areas by reviewing their work papers or looking at the, what I should say is the group audit instruction which has been given to them and how the quality is being maintained by the branch auditors, etc., to enable him to ensure that the unaudited branches by the parent auditor or the principal auditor still is not a concern for the overall view. That is what the expectation which is coming in. Having said that, the new development is expecting the overall responsibility falls with the principal auditor. If the principal auditor is not even mentioning that so many branches are audited by branch auditor, he has relied on the work performed by the branch auditor. My conclusion is that it is a gross negligence of the duty performed by the auditor, and accordingly, it is totally incorrect according to SA 706.
Yeah, thank you, Ganeshanji. I think that is a very, very important point that you have highlighted with respect to the providing the details of the branches. And especially, we have seen that since the appointment of branch auditors are more, especially in the Indian scenario under the banks and certain PSUs, and you don't find the, branch auditors under the private sector companies and especially in the audits of the private sector, this gets overlooked by the auditor in the reporting. So I think that's a very important point that has been highlighted. Vivekji, the next question I would ask you is again on the cash flow statement, where it was noted that there were proceeds as well as repayments regarding the long-term borrowings during the year. It indicates that there were changes in liabilities arising from financing activities. And what has been seen in a few of the cash flow statements is that whatever are the year-on-year numbers, under the cash flow, the current year minus previous year is done, and straight away the net amount is captured in the cash flow statement. So the questions are that whether showing the net proceeds or the net repayment is the correct way of disclosure, and also is there any requirement to provide disclosure of changes in liabilities arising from financing activities with respect to cash flows and non-cash changes, and what can be the examples of such non-cash changes?
Yes, there is a requirement under Index 7, specifically paragraph 44A, which came in 2016 amendment, for entities to disclose changes in liability arising from financing activity. And this disclosure must include both cash flow related and non-cash flow changes. So the specific requirement of the paragraph was that the entity shall provide disclosure that enable user of the financial statement to evaluate changes in liability arising from financing activity, including both changes arising from cash flow and non-cash flow changes. And when we say about non-cash flow changes, and again, coming back to our IBC ecosystem where various resolutions are happening. So in those cases, the debts are getting converted into equity. So there are lots of conversion of debts happening due to resolution plans in IBC. Then there are conversion of debt to equity for convertible bonds, changes in fair value of liabilities measured at fair value. There is foreign exchange gains or losses on borrowing. There is amortization of discounts or premium on borrowing. All these changes in liability which arises from financing cash flows not involving cash. Apart from that, acquisition of asset by assuming directly related liabilities, example, finance lease is there, your accounting for Ind-AS 116 is there, and moreover, we also discussed in the by our co-panelists about equity settled share-based settlements. So all these are examples of non-cash changes that should be disclosed. And rightly said, most of the cash flow, as we discussed earlier also, most of the cash flow people make is from the last year balance sheet, this year balance sheet net difference. And the application of mine goes haywire to understand which is a cash item, which is not cash item. And this disclosure requirement again comes because many changes are happening in financing world with non-cash transactions as the examples were given. So in this case, where it was noted that there was proceed as well as repayment regarding long-term borrowing during the year, it indicates that there was change in liability arising from financing activity. So cash related and non-cash related reconciliation has to be given. And this is an important requirement as per paragraph 44A of Index 7. Thank you, sir.
Thank you. Thank you, Vivekji. Alokji, now I'll be coming to you. In one of the financial statement, it was noted from the notes on the loans that the company has given unsecured business advances at amortized cost, which has been considered as doubtful. However, the company did not make any provision of ECL on such doubtful loans. Is ECL required to be recognized on loans? Further, can a doubtful loan at amortized cost be presented without an ECL provision under the Ind-AS? Alokji, over to you.
Yes, sir. Sir, if I talk about ECL, right? So in our old gap or prior to, I would say IFRS 9, right? Or before Ind-AS 109, there was a concept of inclusive loss model, which was, I would say at the time of 2008 crisis, it was very criticized. And then the regulator or standard setters come up with the expected credit loss model, right? Inclusive loss model was talking about if something worse has happened, then please make a provision, right? There is a objective evidence and you need to make a provision. Expected credit loss is more like a forward-looking approach, right? While nothing has happened, right? Still you make a provision in terms of the expectation which you are having that your money will get bad, right? In the current scenario, when the accounting policy says that your loan becomes bad, right? And this expected credit loss model in terms of Ind-AS 109 is applicable for impairment of trade receivables, contract assets, loans which is receivable from the counterparties. So it is applicable to all those assets, right? And this expected credit loss, it depends on the three-stage model, which is depending on the significant increase in credit risk. In the stage one, it talks about the performing asset, right? So if there is a performing asset, you need to make an impairment loss for the 12 months, right? If it is a significant increase in credit risk, okay, then you have to make a lifetime expected credit loss, and you have to present your loan receivable net of loss allowances, okay? So in the given situation where the loan is doubtful, it means there is a significant increase in credit risk, right? And hence it comes under stage 2 or probably stage 3, right? So going by the provision of expected credit loss, ECL provision has to be made on this loan. It is required, and the loan has to be shown at a carrying amount, at a gross carrying amount, which is the amount of the loan minus loss allowance, right? And the interest provisioning has to happen on the carrying value, which is net of the loss allowance. So the accounting policy is not appropriate, and this ECL, not creating a ECL on the doubtful loan, is not in compliance with Ind AS 109. Thank you, sir.
Alokji, just a further question on that. Can you just explain that whether any amount of receivable loan which is not doubtful, which we typically say good. So again, two questions. One, if it is secured, then whether the lifetime credit ECL loss has to be provided if it is secured and good. Second, if it is unsecured, considered good, whether in that case also. So, typically we have some provision in case of banks, even in case of standard assets. I'm just trying to relate because many of our members do the bank audits and, they are more. So whether this is a very similar thing, if you can throw more light on that.
Sure.
And also that like you have in this case that where there is a specific case. So overall, in all the cases you have provided on a lifetime trend. And then in over and above that, whether in specific cases, more provision in case of the credit risk needs to be provided for.
Correct. So in terms of the provision of expected credit loss, I would bifurcate into three parts. So one is your performing asset, right? Which is good, secured, everything. So performing asset, underperforming asset, and non-performing asset, right? Your asset has to be categorized into three buckets: performing, underperforming, non-performing. So when I talk about performing asset, it is my stage 1, right? It means you know that your asset is performing. In that case, again, going by the forward-looking approach, again, you need to estimate what is your expected credit loss in the next 12 months, not beyond that, right? You need to just estimate for a shorter term. What is my 12 months expected credit loss? If the asset is underperforming asset, so even for the performing, this ECL evaluation is required, right? So you have to make a ECL provision for 12 months losses. Then coming to the underperforming asset, it means that there is a significant increase in the credit risk and it becomes stage 2. Now it needs more antibiotic, right? It means for this kind of a category, this requires lifetime losses provisioning. Now your thinking, your vision is full lifetime. That what could be the lifetime loss on this portfolio, not only 12 months, right? Then whatever is the loss, you need to recognize that loss, and you have to show your loan portfolio net of the loss allowance. Okay. Then the last one is third category, which is into ICU on a ventilator. It is non-performing asset at all. Non-performing asset, right? In that case, of course, you need to create the lifetime expected credit loss provision, and you are not required to even compute interest income on that, right? So from 109 perspective, so this is the kind of compliance which is there in terms of ECL. I hope I have answered your query, sir.
Yeah, sorry, because financial instrument standard is always very dear to my heart. I will also add a simple note for easy understanding. The standard very clearly mentions that the moment you have a financial asset, there is a credit risk. So whether it is performing or not, underperforming or not performing, you have a credit risk. And accordingly, ECL calculation has three parts. The first part is probability of default. So even a good asset, may become bad is what is the assumption you have to have. That is the reason why even cash and bank balances are included as part of your ECL observation. So you are correct that like a standard asset being provided for under IRAC norms, here also we are having the conservative view that if I have a financial asset, even if it is performing, there is a risk which may come at a later point in time. I must project it and make a provision for that also.
Just to add to the two panelists, ECL is obviously doing lots of rounds and discussion. And when we talk to the finance controller saying about the cash and bank balance ECL to be done, and we have to just say that all the assets were standard on some point of time, and it became from standard, or as we said, substandard or under pressure from standard only. So all the assets which are good today, there's some probability, maybe very minuscule, but there's some probability that the ECL has to be there. So, like if you do ECL of say 1%, 2% as per the metrics in trade receivable, for other assets, we should have like a basic calculation of the ECL as per the requirement, and have a minimal, maybe 0.1% also, but minimal, because all the financial asset has to be tested for ECL, and ECL has to be done for all the assets. And still, when we talk about ECL, some of the financials, if you see, they are still following provision for doubtful debts, provision for bad debts. They are not mentioning ECL itself. So a big awareness has to be there for about ECL as well.
And just to add one more point, I think that you asked about the security, if it is available, whether the secured portion requires a consideration for ECL. That also has to be looked into, because when you are having the various calculation in the probability of default, if the security is fully realizable, then the probability of default comes down. And similarly, where I have made already a provision, or maybe I have written off certain asset, if that asset will be recovered, loss given default is also considered, maybe based on recoverability of the secured portion as well. So all these aspects, what we are normally following is already included. Maybe they are using a different jargon system.
Thank you. I know ECL is a topic which is, I would say, most talked about, and I was happy that all our panelists were, itching to jump into it. But this is the response that all of you gave, and especially Alokji, with respect to the ICU and all. I hope the financial statements don't need hospitalization.
Good one, sir.
Yeah. So, Ganeshanji, the next question to you. That
yes.
Bonus shares were issued by a company during the year, and the same was considered for basic and diluted EPS during the year. Is there any requirement that in case of issue of bonus shares, the previous year EPS should also be restated to reflect the bonus issue? And if yes, why?
Okay. This is, if you look at IAS 33 or Ind AS 33, it talks about 2 points to arrive at your earnings per share. One is the numerator and the denominator. When you are looking at the denominator, you are actually looking at the weighted average number of shares outstanding, or equity shares which are outstanding. Let us take an example that current year I have 10,000 equity shares, and the previous year I have say 10,000 equity shares. When I divide my profit attributable to the equity shares by the 10,000 number of shares, automatically in both the scenarios, there is a comparable number which I am arriving at. If I have performed well, my EPS might have gone up. If I have not performed well, if there is a loss, EPS will come down. So EPS will be an indicator of what exactly is the performance made by the company with the capital which has been received by the company. Now, from that scenario, we will take one more example. Last year, I have 10,000 shares. This year, out of my profits, I have capitalized another 10,000 shares as free shares, bonus shares. So there is no actual cash inflows came in, or no resources has been collected, but only the number of shares has increased. From 10,000, it has gone to 20,000. Let us assume that last year the profit was 1 crore. This year also the profit was 1 crore. For hypothetical situation, I'm taking this to make it very clear why that logic of consideration of the bonus shares is coming in in the calculation of adjustment. 1 crore divided by 10,000 shares gives me a different number. 1 crore divided by 10,000 originally subscribed shares plus 10,000 bonus shares issued, 20,000 shares will give me a lesser EPS, or maybe 50% of the last year performance what will be shown. Whereas the company's capital employed is the same number. No addition has added. Accordingly, the standard very clearly says that whenever there is an increase or decrease in the number of shares without actual cash inflow or outflow, then you must assume that this adjustment is available as at the earliest possible period of the financial statement. You have to retrospectively adjust the number of shares of that period also and restate the EPS. Say maybe for the previous year, I have divided 1 crore divided by 10,000 shares. But when I am putting the comparative number for the current year, again I have to say 10,000 shares plus bonus shares issued during the year, 20,000 shares, I have to restate the number. Idea behind that is without any inflow of money or outflow of money, if the EPS has been calculated, it will distort the picture of the actual performance of the company. That is the reason why when bonus shares are issued, we are adjusting current year EPS. We have included weighted average number of shares. The bonus shares also considered for the current year. Similarly, for the previous year also, because the earliest period presented in the financial statement, as per Ind AS 33, we adjust that number also and recalculate or restate that number. Similar to that is, I have 10 rupees shares, which has been split into 1 rupee share. The number of shares increases, but there is no cash inflow. If I am just using the number of shares for the current year alone, my EPS will be showing a different picture if I am not restating the previous year. So the previous year number should also be number of shares adjusted for the denominator has to be taken into consideration due to share split, and we have to work out the EPS. Similar to that is share consolidation. 1 rupee share has been made as 10 rupee share. The number of shares comes down in the current period, whereas the number of shares is very high in the previous period. EPS of the last year will be low, but EPS of the current year will be high if I am just taking the actual number of shares. But the adjustment made for the increase or decrease in the number of shares without cash or inflow or outflow, then it gives the correct picture. That is exactly the requirement of the standard. So in the present case also, when the bonus shares have been issued, they should also adjust the current period EPS calculation by including the number of bonus shares as well as the previous year's number of bonus shares as well. When it comes to diluted earnings per share also, one additional consideration is whether this results in anti-dilutive potential equity shares is what we are talking about. But in case of bonus shares or share split, share consolidation, etc., that will never be an anti-dilutive. And accordingly, it will be in the same line in which we calculate the basic earnings per share by adjusting the number of shares in the current period as well as the earliest period presented. Nothing but the comparative period is also restated. That is the logic behind this. Thank you, sir.
Thank you very much, Ganesan-ji. Now, you see, like we are just about to close the last question, which is coming to Vivek-ji. Vivek-ji, there is a company which is not a financial institution, has adjusted finance cost while determining the cash flow from the operating activities. And the same has been again deducted under the cash flow from the operating activities. The question is the given presentation of the finance cost is correct or not? And the second is how finance cost should be shown in the statement of the cash flow. This is the question with you.
Thank you, Chukji. We should first start. I will take the second question first. When we understand the requirement of paragraph 33 of Ind AS 7, it says that the entities other than NBFC or other than financial institutions, interest paid should typically be classified as cash flow from financing activity because it represents the cost of obtaining financial resource. And interest received and dividend received should be classified as cash flow from investing activity. And dividend paid should be shown under financing activity. So the correct approach for a non-financial entity is to exclude the finance cost from operating cash flow and present interest paid separately under financing activity in the cash flow statement. And not only this, it has been observed in last couple of years and in the starting when people started replying in theirs, not only in their interest expense and interest income showing separately, many people used to net it off, which was against the non-compliance of Ind AS 1, because over there it says that netting off should only be done when it is required under any specific law or any standard. So over there, the things goes for toss again because they used to net it off and show the net figure either in the financing activity or investing activity. That is also an incorrect presentation. Coming back to this question, the given presentation is obviously not correct because the given presentation of finance costs for the company that is not a financial institution, the company has adjusted the finance cost on the operating activity using the indirect method. However, also deducting the finance cost again under operating activity results in double deduction, which is non-compliant with Ind AS 7. And what I have seen again, maybe because of the lack of timing or last minute how cash flows are prepared, the adjusting event or the balancing figure goes in the other assets and advances and loans. Proper review of cash flow statement becomes very important because the stakeholders and the investors takes a great hawkeye on the cash flow statement. So the correct presentation will be showing the financial cost as financing activity and your interest income as a investing activity. And the given presentation and double deduction is not in line with cash flow statement requirement of Ind AS 7.
Thank you, Vivek ji. And it's dot 6 p.m. So I would say that it's been a wonderful session. Since it's virtual, to the panelists, आपको शायद तालियों की गूंज नहीं सुनाई दे, but we are here to acknowledge definitely the efforts. And let me be very honest that when we were stitching together this program last year, we had a very similar outreach awareness program webinar where we had 2 2-hour session back to back for 2 days. So we thought 4 hours, let's squeeze into 3 hours one day. But we were just able to complete 50%. That is the excellent the level of deliberation. And I was just counting that we were able to cover almost 16 of the Ind AS. We have covered topics from Ind AS 1, 2, 7, 8, 12, 16, 19, 23, 32, 33, 37, 38, 102, 105, 109, 115, as also the standards on audit of 700 and 705. So, this is the variety which we have been able to cover today. And like I mentioned earlier, I would request all our panelists to give another 3 hours sometime next week. We'll definitely connect with you, and we would want, so like I'll be very transparent with our participants. We had a original list. We have of 55 questions. We've completed exactly 30 today. So the balance 25, we are very eager that we must discuss that, deliberate them. And in addition to that, we have received a lot of questions from the participants also. But we didn't want to disturb the flow of today. So what we will do is these questions also, based on the original question that were asked to our esteemed panelists, we will share with them. And the questions that were asked by the participants, we will definitely cover them up also in our next session. So with this, once again, a special thanks to our team, our office, our colleagues at the FRRB who put in a lot of efforts to bring together to all these questions from a variety of the standards and the topics by which the webinar has been made very, very interesting. Special thanks to Vice Chairman, sir, for being a part of this event. And finally, it's like an adjourned meeting, but still I would request Ankita ji to propose, give her closing remarks and propose a word of thanks.
Thanks to Chairman also.
Before Ankita ji's closing remark, just a point for the people who are listening. I would request everyone, because there has been now lately think that the physical copies don't come and the soft copy goes on mail and somewhere disappears. The publications of institute and specifically FIB, if anyone makes a small checklist out of the FIB publications, 90% or 95% of the mistakes won't be there in the financial statements. So all those who are listening, they should take a specific effort. And because it's a very all are clustered properly or standard wise specific questions and area wise like Caro reports and all. So it's a humble request to all the members who are listening. Please go through the publication. There are 3 publications on India's financial statement. The third one has recently published in the month of February, March, and the one of the most detailed one. Please go to all the publication. It's really very helpful when you go for auditing, and not only that, you just download it whenever you have any issue with any specific standard. Just go through that standard specific discussions. Most of our problem will be resolved. Over to
Yeah, Vivekji, sorry, I'll supplement that because in all the awareness programs, I have been discussing this, that especially what happens on this technical material. Many times, we find that our members as a singular person gets lost, or does not get motivated enough. I always suggest that in city-wise, if you can have a group of 5 or 10 people, then you get together every fortnight. And let's not be very aggressive that meet daily or meet every week. I would say meet every 15 days. Pick up 20, 25 issues from those publications, which are the commonly found errors, discuss amongst those 10, 15 people and make it a regular habit. That itself would be pretty motivating. And from our side also, we would have less work in identifying less number of errors. So that would also, there is a selfish interest of the board also in that, improving the quality. So over to Ankita.
Yeah. Thank you very much. We are really grateful to all the dignitaries and the panelists to spare your valuable time and making it a resounding success of this program. So looking forward to you once again, and we'll shortly organize the next part of this webinar series. Thank you so much, sir.
Thank you. Thank you, sir.
Thank you, sir. Thank you so
everyone.
much.
Thank you, sir. Thank you, panel.
Thank you, each and every participants also.
Yes.
Thank you very much.
Thanks
Thanks
to
to the team, Secretariat, Ankita and whole team.
Thank you, sir.
Thank you.
Bye, sir.
Bye. Yes, please.